Ladies and gentlemen, our program will begin in 5 minutes. Ladies and gentlemen, our program is about to begin. Ladies and gentlemen, our program is about to begin. Please welcome to the stage Justin B. Smith, CEO and co-founder of Semaphore.
Good morning. Good morning. Thank you for coming. I'm Justin Smith. I'm the co-founder and CEO of Semaphore, a new global news company. We started Semaphore 2.5 years ago with a relatively simple belief, which is that journalism should be intelligent, it should be transparent, it should be global, and ideally nonpartisan. Don't laugh. Today, with nearly 1 million subscriptions across the world, the globe's leadership class is increasingly turning to Semaphore's journalism for balanced news and insights. In our first year as a company, we also had the idea to found this event, the World Economy Summit, based on another simple insight, which is the US is the largest economy in the world, and this country should host an annual gathering of the world's leading CEOs, and that Washington, D.C. was the right convening place for such a gathering. In the first year, 2023, we had 5 CEOs. It was a small affair. Last year, we had 25, and this year we have 200 of the world's leading CEOs, almost half the Fortune 500. And we, of course, did not imagine that the timing this year would work out as it has, with this moment of change and uncertainty in the global economy. And we hope across these conversations that you'll hear from CEOs, private sector leaders, public sector leaders, other influencers and thinkers to do 2 things. How could we continue to catalyze global growth? And how do we simultaneously fortify resilience in what is an uncertain, ever-changing, and shifting global economy? But these conversations here are very different than the conversations that are happening at the IMF and the World Bank. In fact, at the opposite end of the spectrum, because they're on the record, they're journalism-based, and ideally very nonpartisan. And so they reflect the journalistic values of our organization. There are 4 individuals who really have been a huge part of this effort, and you'll see them across the next couple of days, who are our co-chairs. And I want to thank them, David Rubenstein, Penny Pritzker, Henry Kravis, and Ken Griffin. And really an event of this scale, the convening we're doing, which is the largest actually CEO convening in America in 2025, would not have been possible without their leadership. Lastly, I want to thank a few partners, and if you'll indulge me, journalism and live journalism is an expensive affair. We're not an industry known for our remarkable economics, but we have partnered with 18 wonderful companies who see the vision we have for our journalism and for this event, and they include Bank of America, BCG, Chevron, Gallup, Hyundai Motor Group, Mubadala, PMI, PwC, and Verizon. So thank you so much for them. This series of conversations we're starting right now are focused on one of the most urgent and complex stories of our time, the ripple effects of the global energy transition. From AI to accelerating electrification, new forces are placing unprecedented demands on energy infrastructure. And so with that, I'd like to welcome a really consequential person in this transition at the center of these conversations, the Vice Chairman of Chevron, Mark Nelson, to come to the stage to join our first conversation of the day. So please join me, Mark. Thank you. Thank you. So the global energy, well, first of all, welcome, Mark.
Thank you. Good to be here. You said intelligent. I'm not sure you got the right guest, but that's all right.
Well, it was transparent and global.
I can do those.
Okay. Okay. Anyway, thank you so much for being with us. Obviously, the global energy system is going through such change right now, and Chevron is really at the center of so many of these conversations, these shifts. You're one of the world's largest energy companies, and so we're here to talk a bit about resilience, responsibility, innovation, and especially against this backdrop, which is ever-changing. So it's a known fact that everyone wants a resilient and reliable energy sector, but what does that realistically mean, Mark? Well, let's answer that first, and we'll go to a follow-up question.
Well, I think it starts with recognition of a few things. I think we've been reminded in the last maybe decade that reliable, affordable, and ever cleaner energy is vital to progress, vital to security, vital to economic prosperity. And I think people can accept that, but we don't put it in context. The energy system is very large, and it's growing. It'll grow 10% in the next decade by most estimates. We actually need more energy solutions than less, and we need policies that are common sense and durable. So a couple of numbers just to put that in context. I think most people estimate that by 2050 we'll have 10 billion people on the planet. There's still 750 million people who don't have electricity. There's 2 billion people that still are using either cooking stoves or biomass in their homes to create their food at night for their families. A very unhealthy situation. And things that maybe that people often don't remember is how big the energy system is. So you have those gaps, and then you have the scale. Maybe the best way to think about this is, I think with the IEA's recent publication, they talked about in 2024 the size of the energy sector, just how much energy is consumed. And to put it in a context that my children can understand, it's like driving across the United States 23 billion times in 1 year. 23 billion, that's how much energy we consume today. And it took 40 years for oil, which we're all very familiar with, to grow from 1% of the energy supply to 10%. It took 40 years, and that was in a much smaller energy system. So you need focus on energy, and you need time.
And everyone talks about the energy transition. It's it's obviously a commonplace term. People have different ideas of what that means. How does Chevron think of the energy transition, and particularly, how do you apply the real world dynamics or the fact base that you operate with against that question?
Well, at Chevron, we believe that the future of energy is lower carbon. But again, I think you have to put that in context. As a responsible supplier of energy, today we really have to do two things. We have to provide the energy that's needed today in the most responsible fashion while we develop an energy system for the future that, at least in the places that we would play, kind of go to our strength. So we're growing domestic production. We're operating more efficiently. We've reduced this isn't meant to be a Chevron commercial, but we've reduced our methane by over 50% in roughly the last decade. And we're leaning into areas where lower carbon solutions can exist. We are the second largest U.S. supplier of biofuels. We're making significant investments in carbon capture, sequestration, and hydrogen. But the point of all that is you'd want a responsible energy supplier to do all of those things over time.
Mm-hmm. And in that context, what does a responsible, or what Chevron's definition of responsible energy operator look like given consumer and business demands?
Well, so interestingly enough, when you look at, given all of the activity that's going on today, demand for our products not only has not changed, it's either holding or growing across our system. And as I mentioned earlier, energy in general, energy demand is growing. So we have to economically grow to provide what consumers need today, and then do that in the most efficient way possible, both from a cost and carbon perspective, while we choose the areas where we think we can play in an energy system for the future. But notice it's not binary, it's not one or the other, it's both. And we need all those forms of energy allowed to compete in the marketplace so that we have choices longer term.
And how, we're in Washington, D.C., obviously, how does that translate into policy, especially with organizations like yourselves that are considering very long-term horizons, capital expenditures? What are your thoughts on that front?
Yeah, as a company that's been around for 145 years, and just for the record, I've not worked at Chevron for all of those 145, but many of them. I would say maybe a couple of things. We are a long cycle business. We've talked about the scale of the energy industry. So you need policy that balances economic prosperity, energy security, and environmental protection perpetually. You need that balance. And then, as I mentioned earlier, you want to make sure that all forms of energy have a chance to compete. So governments picking winners and losers in energy supply likely doesn't give us the choices we need longer term, both to meet the demand of today and build a system for the future. So you do need durable, common sense policies. There can be differing opinions on that, but the idea of toggling back and forth would make it hard for any industry to make progress. But we're in it for the long haul, and we've seen just about everything in those 145 years.
Yeah, and just looking back at the 145 years, is there a time that's in the past that's similar to now that you can think?
No, I've learned. I learned every cycle, every circumstance is a little bit different. But think about, we've experienced pandemics, we've experienced wars, we've certainly experienced times where sanctions have been in place and product didn't flow as it normally flowed. And what both the energy system and what Chevron always does is you figure a way through that in a way that's good for people that need the energy and for our shareholders.
Yeah. I want to talk a little bit about AI, and I just thought before we get into the more specifics of it, maybe you could just provide the audience a sort of a sense of the AI energy kind of macro picture, because I think it's obviously thrown out there a lot that that the AI revolution is putting huge pressure on energy sources, and there's massive investments going on. The headlines are all around the place. What's going on at a macro level, and then let's get specifically into Chevron's work there.
Well, I'd say at the highest level, it is an exciting potential. And you mentioned the phrase headlines. I certainly see the same headlines that everybody else sees. If you step all the way back, I think from an energy perspective, you have two things that are really exciting about artificial intelligence, some of which we apply already in Chevron. One is the demand for energy. It requires a lot of reliable, affordable energy to have a data center and to have AI work. The second element is then doing all of the energy supply in a more efficient way by leveraging artificial intelligence. The pace of those two things together is yet to be determined.
But how significant is the incremental energy demand? I mean, obviously there are different scenarios and different estimates, but is it? I mean, it's considered, in common knowledge is just this gargantuan demand that may not be able to be met today and needs to be addressed preemptively.
Yeah, I think the hard part, so my daughter's in law school right now, and she's taught me a phrase that's really helpful, and it depends. And I think
my daughter used that line.
I think that today, if you go back in time, if I had to pick a bit of an analog in our industry, it would be the liquefied natural gas business, where people talked all around the world about building liquefaction plants. Multi-billion-dollar investments where you needed a buyer and a seller to get together ahead of time and agree on what was going to happen given the size and scale of the investment. And people said hundreds and hundreds of those would be built, and then many got built, but clearly not that many. So I think today it's a little bit hard to decipher just how many are necessary, but I think it's a significant opportunity. In the case, I'll segue to maybe how Chevron thinks about this, because it connects to that. What do data centers and artificial intelligence need? They need a lot of energy. They need it really reliable. They need backup power. And they have to have permitting and regulatory environment where they can make that work. And they'd like it to be as close as possible to the people that will consume the output. In Chevron's case, we're the second largest natural gas supplier in the United States. And what you might not know is we actually produce 5 gigawatts of power in our own facilities in locations where you don't have a grid available. So the behind-the-meter power opportunity for Chevron is we've done it before. We have a lot of the primary product that will be necessary to make it happen. And we chose to make an arrangement, form a venture with GE Vernova and Engine Number 1, where we have some of the largest turbines in the world, reservation slots ready to go, starting at the end of this year, early next year. And speed is important today. So many of the data centers, a lot of these big players want to be first, and that suits the system we have set up for the moment. So we'll see how it develops. We'll continue to monitor, but in the long run, I think it will be good for the economy, and Chevron will try to figure out its place as to how we can support that.
But it's interesting. I mean, you talk about the speed and the rush to the market. We're also seeing a little bit of a slowdown, pulling back, at least internationally, from some of the big tech companies and some of the financial firms into data centers. Is that a long-term trend as well, or?
Yeah, I'm not sure. I'm not sure I know, but I would say that I think the initial interest is high. people that can find the right location in the energy source, they'd like to be first. How fast they go beyond that, I think, will depend on what the market needs.
And sticking with this question of AI and power, what does that mean for innovation, particularly in this space? I mean, is this the highest priority for Chevron's innovation activities? I know you're probably innovating across many different fronts, but or is it one of several priorities?
Yeah, there's many levels of artificial intelligence, from machine learning to actual AI itself, and we apply quite a bit of it today. And I was in a meeting earlier this week where we were talking about exploration. So this is actually going out and finding new resources for application today. And this goes a little bit again to how long I've been in the industry. But I can remember with a number 2 pencil reviewing diagrams to try to figure out where the oil or the natural gas might be. And then you'd mark that up and you would stick it in a box. And then you'd go look at a basin that looked really similar to that. So another part in the world that maybe had some of the same geology. First off, you'd have to remember where you put the box. Then you'd have to open the box and figure out where that document was. And this was how the whole industry did it. Well, none of those boxes exist anymore because they've all been digitized. They've all been put into a system where you say a couple parameters, and the system will go get all of the information available in our company on that type of geologic setup, whether that's to find things like white hydrogen, which would be naturally produced hydrogen, whether it's to find pore space to store carbon, or whether it's to find oil or gas, natural gas that's needed today. It takes minutes now versus what would be months.
That's amazing. Now let's talk a little bit about the low carbon future. And what I've always found interesting about Chevron is from your leadership on down, a sort of a desire to engage in rational conversations with all sides, and so thank you for doing that. Obviously, the low carbon quest is a sort of a massive, almost never-ending kind of global effort. What are you doing at Chevron to advance that future in particular? And I'd love to, since there's so many public sector and private sector leaders here, the next 3 days, what are the public-private partnerships and policies that potentially could advance and accelerate progress?
Well, I think you've started with lower carbon is a forever thing. So the concept of pursuing a lower carbon energy system, I highlighted the scale of the system. So it's going to take time. So you do need partnerships because no one company, no one country will be able to manifest that desire or that change over time. And so in our case, we specifically focused in the areas where we thought we had the capabilities to make a difference. And so in our particular case, that would be in refined fuels, using a completely different feedstock to create lower carbon fuels. Another area, we produce and manage a lot of hydrogen today. The economics of hydrogen will require some technological breakthroughs, I suspect, over time, but we wanted to lean in to test solutions, and we've got a couple projects underway as we speak. And then carbon capture was another area where we thought, well, we know pore space, we know how to capture carbon, we can probably bring those capabilities together. But maybe more importantly is bringing parties together. One of Chevron's strengths is actually partnership. So gathering people who needed a little bit of support, meaning money, or people who needed a guinea pig, to use a highly technical term, right? Needed a place to go try that particular new technology is something that we've leaned into heavily. So in the late 1990s, we created the Chevron Technology Venture. And that group is designed to invest in companies that need to accelerate technology development. And we're into billions of dollars of money spent. And a year or so ago, we introduced our third energy fund to help people find solutions. And looking back since 1999, of all the technologies that have been developed, where we helped fund, and in some cases we help fund and stay as part of the company. In other cases, we help allow them to test on our operation. 40% of those technologies have been tested in our business, and some have turned into large commercial ventures. Others have helped us improve and have decided maybe not to go further. But it's a commitment that we make because we believe it's good for our company, good for our employees, and it's a good example to everybody else about working together to find solutions.
Great. Well, listen, we've come to the end of our time here. Please join me in thanking Mark Nelson, Vice Chairman of Chevron, for a great conversation. Thank you.
Thank you.
Please welcome Mike Henry, CEO of BHP, and Tim McDonald, Climate and Energy Editor at Semaphore.
Good morning. Good morning, everyone. I'm Tim McDonald, the Energy and Climate Editor at Semaphore. I'm so happy to have all of you here, and really excited for this conversation with Mike Henry from BHP. We were just talking backstage, and Mike was saying, you know, there's a time a few years ago, not so distant past, when critical minerals were more kind of a side issue, maybe not something that too many people were focused on, but I think that situation has clearly changed. Now this kind of story about how do we get the copper and the lithium and all these other minerals that we need at sufficient volume and quickly is a really critical part of the energy transition. Obviously critical for the AI and data center debate, and BHP is a company that's really at the center of that. And Mike, maybe just to start, could you just tell us a little bit about sort of how the company's portfolio has evolved in recent years? And I know you guys are really doing a big push around copper now. Tell us about what's got you excited there for copper.
Sure. So let me start with a little bit about BHP. So world's largest mining company by market capitalization. Been around for well over 100 years now. And one of the things that's allowed us to survive and thrive over time is the ability to reinvent ourselves depending on kind of what's happening in the world around us. And you referenced the fact that critical minerals are kind of now in the public and policymaker, well and truly squarely in the eyes of policymakers. And one of the reasons for that is there's a realization that for, as the world's population grows from 8 billion to 10 billion, more mouths to feed, standards of living rise, all of this is underpinned by metals and minerals. So we're seeing strong growth in demand for metals and minerals as the world continues to grow. All of that then reinforced by the energy transition and by digitalization. If you think about these, and coming back to copper, if you think about these big data centers, super copper intensive, all of the electricity that needs to be produced and transported to those data centers, again, requires copper for wiring. And so as we look at the big mega trends underway in the world around us, we say, well, we want to be positioned on the right side of that. We want to have the big resources that are going to help the world and are going to meet the world's demand for metals and minerals. And the ones that we've picked are steel-making raw materials. The world needs steel as it continues to grow. So we're big producers of iron ore and of steel-making coal. And then the growth commodities for us are copper and potash. And the thesis behind copper is that we'll see copper demand grow by about 70% over the next 25 years. Copper is becoming harder to find, deeper, more difficult to develop. We're the world's biggest copper producer already. We've got the world's biggest copper resources. And so we think that's something where we're squarely placed because of the size of our existing business and the capabilities that we have to help meet that growing demand for copper.
So far, copper has managed to escape the tariff, being tariffed in the U.S. But I know that's currently under consideration. It may be something to watch for in the future. What's your advice for the administration on a potential tariff on copper in the U.S.?
Yeah, so really interesting question, because I think we all get the importance of critical mineral supply chains and resilience and having more production capacity here in the U.S. There's a number of measures underway to help stimulate more production. On the supply side, you see permitting reform being pursued, and it has bipartisan support. So that's making it easier to develop mines in the U.S. Many people in the audience might not know that there's only been a handful of mines, maybe 3 or 4 mines that have been developed in the U.S. over the past 25 years. So it's particularly hard to get mines permitted and developed in the U.S. And the administration is looking at how it can go about reforming the process to make it more efficient while still upholding high standards. And I think that will make it easier for companies like BHP to invest in new production capacity, including in copper. We've seen a number of projects, including one project that BHP participates here in the U.S., undeveloped prospect called Resolution. BHP is a 45% owner, and that's just been listed under something called Fast 41 Transparency, which makes all of the permitting timelines around this project publicly visible. And we've just seen a step forward in terms of one particular aspect of permitting for that project. Now, on the tariff side of things, there's a Section 232 review that's been initiated by the administration. something like 270 days, 272 days to complete this review. But one of the things that will be considered as part of that is should tariffs be put in place in the case of copper. And it's a bit of a vexed question because on the one hand, you can see that tariffs have a role to play in stimulating more onshoring of production capacity across a range of sectors. In my sector, these are particularly big long-term bets. To get a new copper mine developed or a new copper smelter developed, this is multiple $1 billion. Takes probably 5 years from starting planning through to getting first production, and then you've got another 5 to 10 years for payback. And so trying to do that on the back of an executive order tariff can be hard. And so we'd have to
not enough certainty.
Not enough certainty, and we'd have to wait to see, well, how would any tariff be enacted? Is it through executive order? Is it through legislation? What's the nature of the tariff, and so on? But long and the short of it is, I think some of the things that are happening on the permitting front are likely to have much bigger impact in terms of getting projects progressed here.
And I guess my other question on the sort of tariffs and trade trade side of things is, I mean, of course, the demand for copper is also closely linked to just the general global economic health, especially in China. We were talking about this backstage. I mean, do you see this sort of raising of trade barriers generally as a sort of bottleneck for copper demand going forward, especially in China?
I get asked all the time about what's happening in the U.S. and what the impact is on BHP's business, and I say, look, we only have 2 to 3% of BHP's revenue being generated here in the U.S. So direct impact small. The much bigger potential impact is the impact of tariffs and counter tariffs and the general disruption to global trade, and the effect that that can have on global growth. And so if we do see all of that start to weigh on global growth, that will most certainly weigh on commodity demand, and that will impact not just copper, it'll be the whole basket of commodities. So far, we're seeing continued strong demand for commodities in China. There's well-publicized headwinds on the economic front in China, but the sectors that are very metals intensive, so infrastructure, manufacturing, automobiles, some exports, they've continued to perform quite strongly, even in the face of those headwinds. And as a result of that, we've seen the basket of commodity prices hold up reasonably well. Copper price under a bit of pressure lately because of concerns about global growth and overall economic sentiment. But overall, pretty healthy prices.
Do you see that continuing for the near term, or I mean, could that change if we move more into a recession?
Well, if we were to see global growth slow further, then yes, it would change, and you'd probably see more pressure on prices. From a BHP perspective, our whole strategy is built around being in commodities with ubiquitous demand. So we don't like being in commodities with a single end use. Copper used in every walk of life. So that's one of the reasons we like it. Once we're in that commodity, we want to be at the very low end of the cost curve such that in the down cycle, our industry is one that's particularly cyclical, and we want to make sure that at the bottom of the trough that we're resilient and still generating positive cash flows. And so we've got big assets, low end of the cost curve. If we do end up seeing some slowing of global growth, we'll still be in good shape. And in fact, we prosper in the down cycle oftentimes because we see a bit of a flight to quality in our sector, and that benefits BHP.
On the issue of expanding your copper resource, so BHP had a bid last year for Anglo American that didn't work out exactly probably the way you wanted to. Is more? I mean, is there any chance you could go back to Anglo again, or is more M&A on the table still in any way?
So we've been super consistent on our strategy, and what we've said is that we've been clear on which commodities we want to grow, and copper being one of them. We start with the world's biggest undeveloped resources of copper already, so that puts us in a very good position. We then have a number of avenues that we pursue to grow. Greenfields exploration, so we've doubled the dollars being spent in greenfields exploration globally. We're in most continents currently exploring for copper. Early stage acquisitions, so where you might have a small to mid-cap player who's found a new highly attractive resource, we get in on the ground floor and then scale up over time. We've done that recently in Argentina, so a big undeveloped resource there. We look to get more out of our existing resources, and so we've developed new growth projects developed growth projects we'll take investment decisions on in the coming years in Australia, in Chile, this project I spoke about in the US, and then more recently Argentina. And then the final lever available to us is M&A. But in our sector, you have to be so careful with M&A because we have a history in the sector of companies being ill-disciplined in this regard, and and losing a lot of shareholder capital. And so we try to be very selective in which companies we pursue, which assets we pursue. They have to be in the commodities we like, the asset quality we like, and those opportunities are pretty few and far between.
So probably not going back to Anglo. Is that something we should be watching for?
Look, so what I've said is in the recent years, we've done such a good job of developing internal growth options. That really is what management is focused on right now, is figuring out how we can bring these projects through the pipeline and get them into production.
Great. Can you just say a little bit more on the Resolution Copper in Arizona? And you were saying just a moment ago the sort of permitting that's moving along the permitting steps. Well, one thing I'm interested in is in that particular project and in others that you've done, what you've learned about engaging with the local community and indigenous groups, and there's often a lot of opposition to these mines. What have you kind of learned about how to do that effectively?
So first of all, Resolution it's a really exciting project. It's one of the world's best undeveloped copper deposits, and if and when it gets developed, it can supply a meaningful share of U.S. copper demand. But it's been stuck in the permitting process now for 10 plus years. And on the government side of things, that's being addressed through this listing under FAST 41 transparency. The U.S. Forestry Service came out and said that it plans to approve the final, or the environmental impact statement. That then leads to a series of other steps, but which will allow us to start spending on what's called a resource characterization program over the next 5 years, ahead of a final investment decision that could be upwards of $10 billion US. And this is a deposit that between us and the lead joint venture partner, we've already spent over $2 billion just getting to the point that we are. But of course, it's not just about government permitting. We also have to ensure that we have support from communities and from First Nations. And in this case, there's a number of tribes who have ancestral ties to the land in question. And so the managing partner, Rio Tinto, has been very deeply engaged with the tribes, seeking their support and trying to ensure that we have that we've gone through the process of seeking consent prior to a final investment decision. And I think this whole space has evolved over time to be one where what constitutes or what seemed to be of value to First Nations peoples, I think we've gained a much more mature understanding of that, not just here in the U.S., but up in Canada, in Australia, and so on, and where the focus now is much more on not just the direct economic benefit, but also on jobs, on creation of business opportunities for First Nations companies, and so on.
So FID still probably 5 years or so from now.
So it wouldn't be immediate. Of course, we'd like to get to the point where we understand the resource well enough to make that final investment decision as soon as possible. But there's a period of drilling that needs to take place to make sure we've got a really solid understanding of the resource so we can develop a mine plan that optimizes economics and risk.
Yeah, no, I just think it's just an interesting, it's an illustrative example of just the amount of time that really is required to.
These projects are big capital, right. They take a long time, and there's lots of risk associated with them.
I mean, when you think about, how panicked should we all be about the future supply deficit of copper? Are we going to actually get the amount of copper that we really need, or how is that going to happen?
So the Earth's crust is not short of copper units. There's more than enough copper out there. But deposits are becoming harder to find, oftentimes at greater depth and with more complexity, either in terms of how you go about extracting them from below ground, or some of the issues that you need to deal with on the surface, like biodiversity and water and so on. And so the world will get enough copper. Does it get it in as timely a fashion and as cost effectively as we'd all like? It depends. And it depends on whether governments are able to make permitting processes more efficient whilst upholding those high standards, whether capital flows to the right companies that have the balance sheet capacity, the technical wherewithal, and the attitude and approach to social value creation and protection that will allow all of that to happen in a sustainable fashion. And that's still, it's a work in process.
And maybe one last question just on the technology side. I mean, we've been talking about how important copper is for AI, but I know you guys are also using AI more in your own operations. Can you say what has you excited about the potential of AI to help with copper development?
So one of the things I'm most excited about in the case of AI is we actually don't yet realize just how big the potential is. There's many things in our business where we kind of know, we can spot the opportunity, we know how to get from point A to point B. In the case of AI, we can see what's directly in front of us. We have some sense for the potential, But this is something where we will be sitting here in 5 years' time having realized opportunities that we can't even yet envision today. Now, we're already applying AI. We've used it to discover a new deposit in Australia recently on ground that people had gone over previously and said there's nothing there. We applied machine learning to identify a new deposit. We're using it to improve the efficiency of our copper concentrators, to get more copper out of the same infrastructure. And we're using it in our maintenance, for example, to make maintenance of our equipment cheaper, to get equipment turned around and back into the field, producing more copper more quickly. But we've only scratched the surface here.
Yeah.
We are investing in AI startups as well.
Good metaphor for mining companies. Yeah.
Exactly. Yeah. We're investing in startups as well. We've got a ventures investment fund of just under $200 million. 70% of it invested in really interesting companies here in the U.S., including one called Field AI, which is about applying AI into robotics that can be used in mining to make mining more efficient and safer. So a super exciting space in an industry that I know many people might see as being very traditional, but the opportunities in our industry to apply the latest and greatest in new technology are boundless.
Yeah, well, that's great. We'll be watching that closely. Mike Henry, thank you so much.
You.
This is really interesting. Yeah, thank you. Thank you. Thank you so much. I'm going to hang out up here. You get to stay with me for another.
Please welcome Ivan Duque, former president of Colombia, and Tim McDonald, climate and energy editor of Semaphore, will remain on stage.
Thank you. Mr. President, how are you? Thank you so much. Thanks for joining us. Have a seat. Thank you so much for being here with us. Appreciate it. And I would love maybe just to start, for people who are not as familiar with your track record in Colombia, could you tell us a little bit about sort of what were your environmental goals when you took office, and just tell us a little bit about the legacy that you had hoped to leave behind there.
Well, thank you so much, Tim. It's a great honor for me to be here in this Semaphore World Summit. And let me begin by telling you part of my story. I declare myself an environmentalist very early in my life. My father and my mother were conservationists, so they tried to give us an education where we had in our ethical behavior the protection of nature. So in every single part of my career, I have embraced the environment as a main priority. When I was elected president, I had some commitments, and I want them to happen fast. The first one was to expand the protected areas of Colombia. By the time I arrived in office, it was 13%. We had committed with what was called the 30 by 30, which is to get to 30% by 2030. And as we were facing the pandemic, I told my team, we have to do this earlier. So we worked with scientific community, we worked with the private sector, we worked with international philanthropy, and we were able to get to more than 30% by 2022, 8 years before the measure. And that created something very important in our narrative, which was, yes, we want to be carbon neutral, but we also need to be nature positive. The second thing we did is that in a very polarized political environment in the whole world, we were able to pass the climate action bill unanimously in both houses in Congress. And we were able at that time to put several indicators that would allow Colombia to issue financial products that will bring capital for those nature investments, including that we launched in the New York Stock Exchange, the Colombian Green Taxonomy. And maybe I will make another reference. When we started the administration, the weight of the non-conventional renewable energies in the energy matrix of Colombia was 0.2%. So we wanted to have a market instrument, and that's why we had a double-edged auction, and we passed from 0.2% to almost 20%.
Of renewables in the
in the energy matrix.
Yeah.
So I think those were three major things we did, but that put Colombia in a leadership role regionally. And I think today, Colombia is seen as a country of great promises for green ammonia, green hydrogen, but more importantly, for market-driven, nature-based solutions.
Yeah. Can you say a bit about how oil and gas fit into your strategy there? If it's a big exporter of those commodities, and how do you balance domestic oil and gas production with those green goals that you're talking
Well,
about?
I think that's a great question because I don't know why we tend to see this debate always as a yin and yang. So it's a debate of opposites, and I think it's a debate of complementarity. And I'm just going to give you 3 basic facts why Colombia cannot say goodbye to oil and gas without a very long transition. Let me start with this. Oil and gas represent almost 40% of the Colombian exports. It represents almost 35% of all the foreign direct investment in the country. It represents about 25% of tax collections in the country. And at the same time, it is at least 30% of all the market capitalization that we have in the Colombian financial market. So as I used to say, we need to use the richness of the underground to defeat the poverty on the ground. And the nice complementarity is that when you look at the energy matrix of Colombia, almost 85% of the energy matrix that generates electricity and power for the whole country is based on renewables. So it's a very clean energy matrix, and we almost export something close to 60% of the oil and gas we produce, or the oil we produce. So it brings sources that are needed in the country. And when people used to say, how come that you declare yourself an environmentalist, but you have all these policies to keep on working on oil and gas? I said, because energy security, natural security, national security, and human security all have to be seen intertwined. And, which is also something very important, with the oil and gas sector, we were able to create a new narrative and a new vision. For example, Ecopetrol, the national oil and gas company, became the largest auto producer with non-conventional renewables and created a conservation program that protects the rainforest in the country. And we committed to the 1 billion trees, 1 trillion trees initiative launched by Mark Meniyev some time ago. And we committed to plant 180 million trees in Colombia during the term of the presidency. And Ecopetrol was one of the largest leaders in planting trees along the country. So it's not a yin and yang, there's complementarity. And I would finish by saying we have to focus on the discussion on the molecule. And we have to look at solutions, for example, that now are called geological net zero, where there can be reinjection of some of the carbon that has been captured back into the soil. But we cannot see these with ideological premises that only divide instead of focusing on the whole concept of natural and energy security.
Right, because there's been quite a pivot in Colombia with President Petro with respect to this issue. I mean, it's quite a different policy now. Is there some, you see some risk there?
Well, I mean, he was in the opposition when I was in government, and I remember all the things he said. And now when I see him in office, I just don't understand how someone can go to the UN and say that oil and gas are less damaging than cocaine, for example. And he did it, I mean, quote unquote. And he said he's going to stop exploration. So when you stop exploration, you're giving the wrong signals to the market. Market moves somewhere else. And now we're paying the cost of a reduction in our reserves. Gas, we're running out of gas, and now he realized that the gas prices went up. So now he's trying to call Qatar to export gas to Colombia. Imagine the cost of importing gas from Qatar. So those decisions are absolutely insane. And I think his own team is telling him, Mr. President, if you shut down the oil and gas, there won't be even a penny to be invested in the environment. And also, when you look at the environmental policies that he has embraced, he, for example, destroyed what we call the Artemis campaign to fight deforestation in the Amazon. Why? Because there's criminal deforestation in the Amazon. We have lost the equivalent of the size of France and Germany or Texas and California in the last 4 decades due to deforestation. And if deforestation were a country, it will be the second largest emitter of greenhouse gases. So fighting deforestation is the most important thing that we can do in terms of climate policy. Well, it happens that he literally stopped that battle against those criminals. So I just believe fortunately, that we have elections next year, and unfortunately, he has one more year in office.
All right, we'll watch what happens there. We're here, this meeting happening during World Bank and IMF summits here in DC, and we spoke before a little bit about, what do you think would be most helpful from these multilateral development banks for supporting the energy transition, climate adaptation related goals in countries like Colombia? What do they need to do?
Well, as you know, Tim, I spent a great part of my career here in DC working for the Inter-American Development Bank. So I have great respect for the IFIs, and I believe there's a great opportunity. Now, that great opportunity demands clarity on the right financial instruments that can be put at the service, especially in the Global South. I think the Global North has made substantial advancements, but I think the Global South is where the next chapter needs to be focused, and I'm going to give you two very strong arguments. There's high debt in the Global South. When you look at the average debt to GDP ratio is pretty high, so that means you have limited fiscal space. And if you have limited fiscal space and you look at what the Global South needs to invest in order to be net zero by 2050, just in the case of Africa, to meet the NDCs to 2030, they have to invest $2.8 trillion, which is something pretty close of what Latin America needs to invest. So is that money going to come from the budget? I don't think so. There's not too much fiscal space. Is it going to come from bilateral donors? I don't think so, especially now considering that Europe is going to invest way more on defense. So I think there's going to be a crowding out of some of the resources that were appropriated for the environment. Is it going to come from philanthropy? Some resources, yes, but they don't have that size. So the only way to mobilize massive amount of capital for net zero and nature positive solutions is through the market. And then the question is, what are the instruments you need? And then that's why I think there are four things the countries need to do. One, we need to make the green taxonomies a model to be implemented by all the countries so that they can clearly demonstrate which are the key indicators that they are going to meet in terms of carbon neutrality and nature positive solutions. Second, you need guarantees because most of the public investments that ought to be done have to take place with the local governments. And what happens is when they ask for a guarantee from the World Bank or the IDB, it is accounted as if it were a loan for the national government. So that's why there's no incentives for the national government to give big amount of money, long-term funding for a specific climate action investments. So that requires guarantees for the local governments that are very well structured, but can create a way of mobilizing capital. Obviously, the green bonds and the carbon credits and biodiversity credits, but there's something even more interesting that I have been proposing, especially for the IMF. The IMF could incentivize countries to have facilities that for a certain period of time will not be accounted on the fiscal deficit. There could be special investment vehicles to accelerate the climate investments. And obviously, they require great level of monitoring. It requires great level of reporting. But I think it's the only way that we can accelerate what is pending in terms of climate action. Otherwise, by 2030 or 2050, it will be too late, and the cost will be triple what you have to pay today. So I think those are elements that I would love to see the multilaterals this week embracing it with great determination.
Yeah, that's so interesting. A way to hopefully do that without creating a lot more debt for these countries, right? I guess my last question was, we have a COP summit coming up this year in the Amazon, which I think is going to be really exciting. But of course, it's also happening in the sort of background of the U.S. Not really participating in this multilateral climate diplomacy anymore under President Trump. There's a sort of general pull away, I think, from these types of forums. What's your view on the sort of state of global climate diplomacy? What are you hoping to see at COP this year, and how significant is it for the U.S. to not be playing a big role in that process anymore for the time being.
Tim, I've been to many COPs, and there are good COPs and bad COPs. So, with that said, I believe there's an opportunity, and there's a big risk. Let me start with the risk. The risk is that this COP will end up being a whining context from the global south versus the global north. It can easily happen. If that occurs, it will be a lost opportunity. Why? Because for sure there'll be a lot of populists from the global south saying, you know what, we're paying the cost of all this climate destruction that has taken place with the economic expansion of the global north, so you need to pay us more money and more money so that we can do what we have to do. That's the easy possibility, which is quite risky for being a bad COP. Now, if you wanted to make out of COP30 a good COP, I think there are three things to be addressed. One, every single COP, there are too many pledges, too few disbursements. So let's use the whole financial IFI system. Let's also use the market and determine what's the fastest way of disbursing some of those pledges that are to be focused on the two main sources of greenhouse gases emissions in the global south: negative use of land, deforestation. And obviously you have a combination of transportation, clean cooking, and the fact that you need to have more cleaner energy matrix. How do you do it? I think there are the four instruments that I mentioned: the guarantees, the taxonomies, the credits, either biodiversity or carbon with more integrity and maybe fair pricing for carbon. And last but not least, how to unleash resources with the local governments. But that would only be possible through these kind of facilities that for a period of 10 years would not be accounted in your fiscal deficit accounts, but will be a scroll account with great transparency, focused on every penny invested in meeting the NDCs. That, if happens, which I see people willing to be advocates of this, will be the great opportunity to be addressed in Brazil.
Yeah, great. Okay, well, see you there. We'll
Thank you so much.
Okay, thank you so much,
all.
President Duque. Thank you.
Appreciate it.
Thank you very much for your time. Thank you.
Thank you so much.
All right.
Please welcome Tim Cawley, CEO of Consolidated Edison, and joined by Tim McDonald, Climate and Energy Editor at Semaphore.
Thank you. Great. Thank you all for bearing with us. Hey, Tim, hi. How are you? Good to see you. Yeah, welcome. Yeah, good to chat. Thank you. Tim, thank you so much for being here.
Thanks for having me.
And we've got a good, over the next couple of days, I have a few conversations with power company and utility folks. But you're the first one of the day for me. Really happy to set the conversation that way. And utilities obviously are at the center of the energy transition in just about every way you can think of. Con Ed, probably there are probably people in this room who are your customers, paying your heating and electric bills. Could you say a little bit about what makes Con Ed's territory unique? Because often when I'm interviewing utility CEOs, the conversation very quickly goes to data centers and all of that. I think your load growth story is a little bit different. What are you anticipating there?
Yeah, it is, Tim. And some are customers, and many or all have been through New York City, sort of enjoying our products. So we serve 4 million electric customers, 1.2 million gas. And we have a steam system from 96th Street to the Battery that heats and cools the big buildings, the Empire State Building, Rockefeller Center, et cetera. And we deliver really reliably for a reason. We're a vertical city, the New York Stock Exchange, transportation hubs, et cetera. So we've really got to be reliable. We are 9 times more reliable than the national average. And so all of my colleagues, or many, will be talking about data centers as the load growth engine for them. And we'll see some data center growth, but really ours has to do with broad electrification. So you think about vehicle electrification, EVs, both passenger and fleets in the New York City region, as well as electrification of heating. As customers move away from oil and natural gas to heat pumps, mostly air source heat pumps, some geothermal, that will drive our electric demand. And that's really driven by New York State's very aggressive and ambitious policies around climate and resiliency and energy security, amongst the most ambitious in the United States. And so we've got to get ready for that and make sure the capacity on our grid is there to serve reliably, as I said earlier. By way of example, when we get a request from a building today, the demand they're asking for is about 20 to 25% more than just 5 years ago. Wow. And that's because they're outfitting their buildings with EV charging infrastructure, sort of thinking ahead. And there's some legislation in New York, first in the city and then the state, that requires new buildings to not connect to fossil fuel and to electrify. So the new buildings are going up with electric heat. And so rather than sort of a gigawatt in a field of data center demand, we're going to see progressive demand spread very evenly across our service territory over a long time, and that will yield really big investment opportunities for our team.
Yeah. So what is that? So what does solving for that look like for you? Is that this? You have to build more generation, build more transmission, and I'm wondering, in that process, obviously we're all here talking about tariffs and the trade war. I mean, does that raise costs for you if we see steel and other inputs getting more expensive? What are you anticipating there?
Yeah. So on the first part of the question, what do? We plan ahead. We're 200 years as a company. We started out in 1823. Using whale blubber to light lamps on the Lower East Side. So we've come a long way, and we will go a long way from here.
Back to whale blubber.
Maybe not.
Okay. Yeah.
We'll see.
Yeah, we'll see. Yeah.
Dynamic times.
Yeah.
We're the longest continuously listed stock on the New York Stock Exchange. So we're steady, we're iconic, we're woven into the fabric of New York, and we're really proud to be able to serve that region. So in terms of serving that demand, we plan and build. Right now, for example, we're building 4 substations across the boroughs of Brooklyn and Queens to support the capacity that will be needed as the electrification occurs. If anybody's been in and out of LaGuardia Airport or JFK Airport, a lot of build there and a lot of electrification of baggage handling, the fleet services, the lifts, the Ubers, they're all going to electrify. So we need to build out the capacity now to meet it for the future. You mentioned tariffs. Like many, we are sorting through that. It's very dynamic. We've got an eye on it. A lot of our big equipment we do purchase from abroad. So we source large substation transformers. The substation transformer is about as big as a small house. And we'll bring those mostly from Europe. We buy from Canada and Mexico. We buy a bunch from the United States, but we're beginning to work some sensitivity analysis into our capital investments to understand how much that'll impact. We have an investment plan in front of our regulator where we plan to invest $7 billion a year in infrastructure upgrades and capacity build out, and we're trying to work in what the tariff impacts might be to that.
I mean, do you see those impacts, as an impediment to energy security for the U.S. or kind of power access and affordability?
I think the way we have for decades, we're going to have to work through it. It's another constraint for sure that we're going to have to work through. It's not the only constraint the industry's worked through, and we've got a lot of innovative people at Con Edison and across the industry that will help work through that. And it'll spur innovation within the utility industry itself, I think.
Yeah, that'll be really interesting to see. And you mentioned investment plan that you have with regulators. Can you say a bit about how this sort of load growth that you're trying to do at the same time as decarbonizing and meeting these climate goals, what does that mean for your customers' power bills? Should we expect to see those go up, and what are you asking for there?
Yeah, so they will go up, and we're in an 11-month process where lots of stakeholders, interveners come in, and we sort of work through what the best balance is with regard to progress on clean, certainly need to be resilient and secure. I mean, it's the financial engine of America and maybe the world in New York. We have to get it right. People's safety and livelihoods depend on us. If you go to the U.S. Open on those really hot days, you're enjoying, the tennis players are sweating, we are behind the scenes working to make sure that happens. So we have to have it right. So it's a balance between transition to clean, reliability without compromise, and safety for our folks. We've always focused on affordability. I would say never more so than now. I'm 37 years in the company right out of college. I'm not unique in our company. Many of us in the leadership roles have come up through the ranks. And we've always focused on it. And I'd say we look at three things. First, being really great stewards of the customer's dollar. So be efficient with the spend. Use data and analytics and technology to take costs out of the business on behalf of the customers. Sort of do more with less. The second is energy efficiency remains and will forever be our best tool. So sort of providing insights and tips to customers on how they can reduce their consumption is good for the environment, sort of the negawatt. You're not making that power independent of its source, and it's good for the customer bill. So we really push energy efficiency. And the third prong that we're particularly focused on in our service territory are folks who are on lower incomes. And as we transition to more resilient grid, more secure grid, a cleaner grid, those folks want it. They are just not in a position to pay for it. And so we've got some tariff structures such that if rates go up, they're tethered to an energy burden of about 6%. And so while there's no average low-income customer, that's sort of the objective, to provide subsidy for those folks. And about 14% of our customers are on public subsidy. And so the other 86% will have to fund that 14%. We've been doing that. We lean in hard because we think without taking care of that group of customers, what we provide is essential. It's not a choice. You really need energy. And so if we didn't take care of those customers, it would really throw the transition and the resiliency and the security out of whack. So big focus there.
Do you see that share of customers that have a subsidized tariff increasing over time as the bills become more expensive? We have these like capital costs that you have to put in?
Yeah, really great question, Tim. And we haven't. It's been pretty flat. We had a big perturbation during COVID, and many utilities did, where for all the right reasons, if people didn't pay us, we did not shut them off. And when we do a disconnect, it's really, we don't want to disconnect customers. It's to get their attention, to get them on a payment plan, to sort of re-engage with the customer. But we stopped collecting. The arrears went way up, but they're working their way down. And that 14% has hung in there pretty steadily over the years and through different economic disruptions.
Well, Tim, can you say a little bit more about your generation mix and how you see that evolving over time, and how does that fit in with the climate goals? Do you see more renewables, or what? How do you see generation mix changing?
Yeah, so it'll change as we move forward. New York State has very ambitious goals in this space, and I think they set a very high North Star, and whether or not it gets achieved, it sends a strong signal. So right now in New York State, about 30% of the power generated is from renewables. Much of that is hydropower, but also some wind and solar. The goal in New York State is to get to 70% by 2030, really unachievable by everybody's sort of reckoning, but the position moves forward. We are a wires and pipes utility, so in the late 90s, we deregulated. We used to be vertically integrated. We made the power, we transmitted it, and we billed it to the customer. We sold our generation as part of a policy decision to make generation competitive at that time. So we are really just supporters and enablers of the generation in the state. Third parties come on and raise their hand to put in either solar or wind, typically in New York State, and we're there to do the studies to connect it promptly and make sure our facilities can absorb it. So I think we'll move toward a cleaner portfolio. It'll take time, and like I said, we've been at this for decades, and we'll be at it for decades.
Yeah. Is that more complicated when you have more distributed energy, and you're trying to plan the wires around that? I mean, how have you sort of dealt with the sort of decentralization of the generation mix over time?
Yeah, so just for context, in our service territory, on the hottest day in the summer, we'll serve about 13,000 megawatts. You don't have to write that number down, but that's context. We've got about 1,000 megawatts, or 1/13 of it, is on rooftops. So our customers have really migrated and transitioned toward an affinity for renewables there. And we really want to avail ourselves to that capacity so that we're not double counting power. And how do you aggregate thousands and thousands of rooftops and get a portfolio solution that can offset some generation? We're working with the New York Independent System Operator, who runs the grid for New York, a single state operator, along with FERC and others, to find ways to aggregate and understand with certainty what that is. Smart meters help us with that. We'll see what we're getting. we need to count on that power to keep the lights on. We can't sort of catch up in 5 minutes or else the lights will go out. So I'd say it's getting more complex, but the data analytics that we have and the technology is more complex as well. And I think up to the challenge.
Yeah.
Yep.
I mean, on that complexity question, I was also going to ask, you mentioned electrification of buildings, electrification of vehicles, things that you are going to have to deal with. I mean, how much visibility do you have as the power company into what to plan for there? I mean, if the Uber fleet at the airport is going electric, I mean, are they telling you that in advance? Or, I mean, how do you sort of know what to be able to expect there?
Yeah, great question. And load forecasting has become much more dynamic. Several fast charging EV chargers have the same amount of electric demand as a small apartment building, and it really has to do with coincidence of load. So if you have 3 chargers, if you pull out, I'm going to pull in, and the 3 cords are all pulling at the same time, whereas in an apartment building, a bunch of people are gone, some are sleeping. So we really have to get a good handle on the dynamics of load management. We engage with customers early. They know it's to their benefit to engage with us early because we often have to build the grid out to meet their needs. And we do 1 year, 3 year, 5 year, 10 year, and 30-year programs to sort of lay out the infrastructure build. And so we're keeping a close eye on it. It's much more dynamic. In days of old, we used to have an algorithm on demand increases that went to population, regional GDP, census. You sort of grind it and you'd come very close to what the demand is. Now with electrification of heating and particularly fleets, we're seeing that become much more dynamic, and we're putting more effort into making sure we're ahead of that. Again, we need to serve this region with incredible reliability, and the only way we can do it is to build the grid out ahead of the arrival of the demand.
Yeah, definitely. Tim, I guess just one other question I was going to ask about this New York's climate goals. Obviously a very important kind of signal for your business. President Trump had an executive order about a week or 2 ago on looking at ways to restrict the ability of states to set their own climate goals. I mean, is that something you think the federal government should be doing, or what's your view on how those state climate goals might be affected there?
Yeah, and Tim, maybe I'll just comment on what's gotten us to this point. The state has leaned into these policies quite aggressively through elected officials, and I think that's the path it'll be on. They have had the greatest say to date. We'll see what happens. It's a very dynamic time, as you know. But I think we serve New York City and the surrounding region. We are regulated at the state level. We obviously engage with FERC and follow those federal rules. So we'll have to see how that plays out, but there's a lot of both New York City and New York State legislation and policymaking that drives toward a cleaner, more resilient, more secure grid over time. And we think that's what our customers want, frankly. It's all balancing with the cost of this, and that's why we have really good, constructive debate over that. But I think right now, if I were to look back and apply lessons from history, the state and the city will continue to lean into this quite aggressively.
And it sounds like from what you've been saying that kind of goal setting at the state level is not too onerous for the company, or that's something that you're able to kind of play within that structure pretty well?
Yeah, we can certainly play within it.
Yeah.
And frankly, we're supporters of it. And if you think about the energy company, we've got some incredible engineers and planners and supply chain folks that sort of make this happen. I said 9 times more reliable. We're moving electrons 9 times better. The Concorde was twice as fast, right? So we're really proud of that, and that's a lot of good people working hard at it. And so because we know so much about the energy systems, this is about moving cleaner generation. It's about facilitating battery storage, energy efficiency, charging. Our folks know how to do this. And so we think we can play a really big role in ensuring that New York and the region efficiently moves forward on this, keeping reliability and security at the forefront.
Okay, great. Tim, thank you so much for this conversation. Really appreciate it, and we'll be watching closely.
Thanks for the time. Thanks.
Thank you.
Thanks
Thank you. All right, that's it for me. Thank you all. Thank you all so much.
Ladies and gentlemen, our program is about to begin.
Please welcome Gina Chan, Senior Editor for Semaphore, and Yinka Adegoke, Africa Editor for Semaphore.
Hi, everyone. Thanks so much for joining us. Yinka and I are sort of doing an impromptu interview here because the Congo finance minister who we had scheduled for this session could not make it. So instead, I'm going to interview Yinka about him and see what his thoughts are about what's happening there and the rest of the continent. So Yinka, I wanted to start off with sort of a big picture view of how the Trump administration has approached the continent, because I think there were some thoughts that he's going to be focused on China, he's going to be focused on Europe, and Africa may be, less on the radar for him. But I think we've seen a lot of consequential changes for the continent. Can you put that into context for us?
Yeah, I think you're completely right to lay it out that way. I think in the run-up after the election, I spoke to people and they talked a lot about, well, the opportunity here is, this will be a lot more of a transactional government and administration, and, there might be some opportunities, but Africa won't be a priority. And in some senses, those kind of expectations, those kind of forecasts are kind of true, but at the same time, there are real consequential impacts from just the general approach of the Trump administration. You can look at everything from, I think that even you saw the story just this past weekend about, they're going to get rid of, the Africa bureaus and all this kind of stuff. And this has been out there even during the election, right? This idea. But far from it, they are really focused on relationships, direct relationships with countries with critical minerals, or geopolitical sort of relationships which can impact other sorts of broader agendas that the Trump administration might have. So rather than being this kind of forgotten about place, there are just individual countries or regions who are really going to see a sort of almost closer U.S. relationship if they play their cards right? But the sort of broad, the big picture sort of thinking is, things that sort of looks like the U.S. was doing because it was the right thing to do, that kind of thing. Mm-hmm. That's what's going away, right? That and everyone here knows about the dismantling of USAID, the likelihood that the preferential trade agreements with African countries, that AGOA is likely not going to, survive in its previous form. It probably greatly weakened, clearly, with everything else going on with trade policy. So those kind of things which seem like this is the way you help support and engender, healthy countries and grow consumer markets elsewhere, that American companies and Western companies could sell products. So that kind of focus is kind of gone away. And it's more like, it's more about what deal can we do with you? How can you help us with our agenda?
Sure.
And, there's an argument to say that maybe some countries, some leaders in some countries might be able to, play their cards right, maximize that and get something progressive out of it.
Well, how has that changed your reporting and what you're hearing from your contacts? Because I find that people are so at a loss, whether it's CEOs or leaders of countries are at a loss of trying to figure out how to deal with this administration, who has influence, especially when that seems to change day by day. Like, are your sources, both on the business and government side, being like, hey, Yinka, like, who am I supposed to talk to at the White House?
We're both journalists.
Yeah.
We go through the same thing.
Yeah.
We're all both going through the same thing, and it's kind of so it's funny for you and I to ask that of each other, but it's definitely an issue, right? You know, there are real concerns. I think the Africa space, which is obviously very, very different from you know, Capitol Hill and all the other sorts of congressional politics and all the rest of it. You know, because what you have in that space, and anyone who's even, particularly DC people who are even remotely connected to it, kind of understand that it's always been a very bipartisan, very kind of, you know, people work together a lot. It doesn't matter whether they're on the right, the left, Republicans, Democrats. Some of that has gone away. And there are a few people trying to hold on to the old way of doing things. That it doesn't matter where you sit, because we're all about you know, pushing forward a kind of U.S. Africa policy which supports the U.S. and also supports you know, the African countries. But there's also a sort of sense that there's a big change, and people are concerned as to who has the power and who's in charge of what. There is some confusion there. You see that across the administration on so many different areas, but definitely with the Africa space, it's a real thing.
Who is filling the void? Because we have seen, as you said, USAID cut funding, their whole staff being decimated.
Right.
You know, you talked about this being a very transactional government. Does that leave room for, you know, countries like China that was already trying to make inroads into the region? We've seen, you know, the Gulf countries be ascendant on their own in this administration, and possibly opening more doors in that, you know, between the Gulf and African countries as well.
Yeah, all of that is happening. All of that is true. Of course, the China-Africa relationship is, you know, long-standing, for at least for the last 25 years or so. It's been very, you know, it's grown very rapidly, and that is going to continue to happen. The nature of it is evolving. You know, they were previously focused on big infrastructure projects and programs, and now they're looking at slightly smaller things, but in terms of the relationships with the governments and with businesses on the ground, that remains strong and will continue to happen. The Gulf countries, in particular the UAE and to some extent Qatar and Saudi, are definitely stepping up in terms of investments. They don't have, obviously, the kind of infrastructure, kind of expertise or knowledge or people to really do a hands-on kind of thing, but they definitely have the investment capacity.
Yeah.
And they are, you know, investing across the continent. They're also getting involved in kind of geopolitical issues as well, as we've seen in Sudan, where they're, you know, the UAE in particular is very much involved in that conflict. So there are opportunities for all kinds of people. I think what people who cover the region sort of feel is a bit of a shame about the sort of U.S., especially that the U.S. has, particularly through USAID, has been a really strong player and partner on the continent in terms of, you know, everything humanitarian and health projects. that has just, spent billions and has earned tons of goodwill towards the United States and United States citizens. And it just feels like that has just gone away, and nothing is really replacing that. On the continent, lots of Africans, you see that lots of African kind of, what should we call them, the chattering classes, whatever you want. We will say, yes, it's about time our governments took care of our people, and they need to stand up on, on their own feet.
And not rely on
not rely.
USAID
Yes,
or
I mean,
others,
they've been getting this largesse from the US, and they haven't, sort of pulled themselves up and stepped away from this over time. Instead, the entire health ministries, which are like half of their budget, was USAID. So they're kind of, pluses and minuses to this. We just don't know how it's going to play out. But there's no doubt that this is a time when many countries see an opportunity.
So which countries in that environment in Africa do you feel are thriving? I mean, we've seen the South African ambassador, the previous one when he was criticized, the Trump administration, we saw how quickly, how that turned for him. Are there countries that you feel are actually playing it well in this environment where sort of who's up and who's down is changing by the moment?
Yeah, in sub-Saharan Africa in particular, I don't see any standing out just yet, which is not to say this can't change very, very quickly. I mean, DRC are clearly the ones, and this is some of the stuff we'll probably have the minister again. We'll probably have him tomorrow because he had a conflict. But they are one because they have all these huge trove of critical minerals, and the Trump administration has created a special envoy kind of role with Masad Boulos, who's gone down there to not only help them with speaking with the Rwandans about the conflict in Eastern DRC, but also to figure out a way, as we said earlier, in that kind of transactional way, in which, well, if we help you solve this, can we create a situation where US companies are able to, have some say in the critical mineral supply there? The question I will ask when I do speak with the finance minister or any other official, and I've asked this privately, is how does this help the Congolese people, right? How, the consideration, what kind of, there's always a fear because of Africa's history, like, well, what are we doing here? Are you just going to come and take things and go away, or are you going to build
all the
factories?
oil-rich countries where you see like where, what
time
are
and
the
time
effects
again.
for the rest
Exactly.
of the people?
Exactly. So
And what is their answer?
well, this is what we, well, obviously, on the face of it, they'll say, yeah, it's going to be great, but we don't know. The details are really what we need to find out about. There are early concerns with some of the individuals involved, but, one likes to think, it's 2025 that they will figure out a way to do this in a way that's beneficial to both sides.
Yeah. And what do you think that looks like? Is it, some kind of profit sharing that, that is ensured, that goes to the people? How do you see the mechanisms for this, especially because it hasn't worked in so many other situations?
I think on the face of it, what they want to do is just give preferential licenses to American companies. That's the sort of the starting point. Now, how they do the details of sharing out profits is still what they need to reveal. Remember, the context of this, of course, is that Chinese companies are pretty dominant in the Congolese supply chain. So it's a way of keeping out the Chinese or reducing their impact. Although, again, they're so deep in that supply chain, It'll
It'll
take
take a
it'll
while.
take a
Yeah.
while.
Well, hopefully we'll have a chance, or you'll have a chance, I should say, to
Lots of
ask
stories.
him all of these questions.
Yeah.
So hopefully all of you guys will stay tuned for that one. But thank you so much, Inka.
Thank you. Thanks, Gina. Thanks, guys.
Please welcome Patrick Maloney, co-founder and CEO of CIV, and Reed Albergati, tech editor at Semaphore.
All right. Patrick, thanks for being here.
Of course. Thanks so much for having me.
So you just started this $200 million fund
Yeah.
to reinvent critical infrastructure. You know, it doesn't seem like a huge amount of money when you look at, you know, BlackRock with $100 billion, right?
Totally.
So how do you do it with, you know, what's the plan with, you know, with that budget?
Yeah, of course. So just to kind of set the stage, so Civ, you know, as an investment firm, mostly backs, but every so often will sometimes build companies on platform. And predominantly we're investing in early stage ventures. So everything from the earliest stages of we have a thesis and an amazing outlier co-founder and we'll build that company together, or we'll find an amazing company outside that we can then invest in and help bring operational capabilities to help that company go faster. But where we invest, we're investing usually between $5 and $20 million in the early stages of a company. And then those companies, as they get to commercial success, that's traditionally when we then go work with a BlackRock or a GIP or any of the major infrastructure partners to now scale the actual infrastructure.
So it's kind of like you're developing new technology that then bubbles up and that becomes, that's how we change things, essentially.
Oh yeah, I mean, listen, I think that we invest in a very specific way. So we predominantly look for what we call scale tech. Deep tech is fantastic, but we tend to find it's too capital intensive and too long duration for a 10-year fund cycle. And so the first thing we're always looking for is like technologies that we can scale today. The second thing is we really love to find technologies in demand-driven markets. This is where the large conglomerates actually need and want what we have. And then the last is, of course, proven unit economics, where these things can actually scale on a completely dispassionate basis, just based on purely their economic merit.
So we were talking earlier about how you think AI is going to change the physical economy. And so what do you view that labor, what is that going to look like in the near term or like in the 10-year horizon? What's your vision there?
Yeah, vision for labor. I mean, listen, I do think we're in a moment right now where there's a couple key megatrends that are completely reshaping the physical world, right? We have AI and compute and just the voracious power needs associated with the transition to an AI-driven economy. The second being, we've now deglobalized. It started with COVID, and then it got accelerated with Ukraine, and now, of course, we're finding ourselves in a world where tariffs are forcing everyone to rethink their supply chains. And then, of course, lastly, we're electrifying everything. And the combination of those three trends are driving a massive transition in the global economy. In terms of labor, I mean, I think we've seen these transitions historically across many cycles, and we always tend to find a world in which that labor gets reallocated across the economy. And so I think we're going to look out 10 years from now, we're going to see a world increasingly powered by AI. It's going to reshape the way productivity is defined in the global economy. We're going to see the world increasingly built by robots. And we're going to find a restructuring of the way that labor is allocated within this new world.
And so what do you think actually needs to happen? Because obviously a robot worker consumes a lot more energy than a human worker today, right? Yeah. So, I mean, what do you think needs to happen to sort of make that vision reality?
Yeah. Well, for the 20 years prior to 2020, we were in a low demand, low volatility environment for energy, right? And then given the mega trends we were just talking about, now we see ourselves in a world where we have inflecting demand for energy and yet relatively fixed supply. And so everything in the middle of that dislocation is getting significantly more valuable. Companies that can solve for creating greater efficiency is literally just driving pure profitability within those industries. And so you're either creating greater abundance of resources, greater efficiency within the use of resources, or greater resilience within resource ecosystems. In our view, fundamentally, that's where value is going to be created across industries.
Yeah. Well, and so you're reshaping things, and you've also been involved in clean energy in the past. We have an administration now that wants to power AI data centers with coal. So do you feel like you're sort of working against the tide here?
You know, I mean, I think that, I think we're in a post-ideological world because the reality is right now, the rev limiter to AI isn't chips, it's power, right? I mean, you can just look at the example of, when Microsoft announced their earnings in Q4, they lost 6% of their market cap, or $180 billion in a single day, not because they, because they missed their forecast on data centers, not because they couldn't get the chips, but it's because they can't get their power. And so right now we're just in an absolute arms race for electrons because everyone realizes that those electrons are the input to all of their future prosperity across the hyperscalers, but also the industrial players. And so it's going to be everything from what I can tell. We're going to need to, one of the first companies that we built on platform was a nuclear company. And so, we've talked about nuclear forever, but, we always viewed, hey, this is probably the greatest thing that we've ever invented as a civilization, yet we haven't been able to deploy it here in this country for the last 30 years. But it was obvious to us that it was now going to be imminent, given that the demand was driving the need for new 24/7 firm power.
So do you think just to follow up on that point, before we move on to nuclear,
yeah, of course.
it's an interesting one, but do you think that it doesn't matter what the administration does or says, that this is sort of, the ship has sailed and we're going to move into these new technologies and, greener technologies regardless, because the private market's going to...
I mean, I think at the end of the day, what's going to scale is what always scales, which is better, cheaper, faster. And so provided that these technologies are now driving better, cheaper, faster within industry, I think you're going to see those things scale. And to the extent that they don't, they're unlikely to scale. But that's always been the way the economy has worked, from what I can tell. And so I do find that we're now in a world where we're post-ideology. For a long time, we were talking about the existential threat of climate and the need to now deploy cleaner, less carbon-intensive technologies. But now we're in a world where, given the demand is driving the need for an abundant source of energy, we can now find ourselves in a world where these things are now commercially viable and can scale on their own economic merit. And if they can't, then they shouldn't exist, and that's like totally fine to me. It's like at the end of the day, if there's no actual market for it, we shouldn't be investing capital into those industries unless government can, philanthropy can, but industry certainly isn't going to.
Okay, so let's talk about nuclear then, because that's one of your big things. I mean, I think nuclear has some big problems. So there's the not in my backyard problem, right? Mm-hmm. There's the problem of it's essentially, it takes forever, right, to build these things, was like 10, 15 more years. Mm-hmm. And it's also generally not profitable. Mm-hmm. Hasn't really been that profitable in the past. Mm-hmm. So how do you get over those hurdles?
Yeah, so I mean, I think that, just to kind of set the stage, when we looked at this, we said, hey, we are now in an inflecting demand environment, relatively fixed supply, and our view is there was no way to cross that chasm except the one thing that we had already solved 70 years ago, which was, fission nuclear power. When we looked even deeper into that, we're like, well, actually, it looks, we've been very successful in deploying reactors. Today, we are currently, what won't be for long, the world's leading superpower in nuclear energy production. China, as many of us may know, has 400 reactors in their pipeline. In the next 10 years, they will surpass the US as the leader in nuclear power generation. But when we really looked at the problem, we're like, hey, it's interesting that we kept on wanting to put more capital into creating a new reactor. If we already have 94 today, that suggests to us that we actually have fantastic reactors. We have great technology. We just haven't been good at deploying those reactors. We've only deployed 2 in the last 30 years. And so that's why we decided to build a platform called the Nuclear Company, which is a software-enabled fleet-scale deployment platform focused on using proven technologies that we already have NRC approval for today on approved sites. This gets to your NRC, your NIMBY question. Most of these sites are actually already next to an existing nuclear generating asset, meaning those communities are already very familiar with and in living next to nuclear power generation, which is the fastest path to be able to deploy. But we did it at a fleet scale, scaling up the way in which we're deploying reactors, so design once and build many.
So do you think you can get to like economies of scale, essentially, right?
I think
which are not there today.
Yeah, exactly. I mean, we literally have decimated our supply chains of labor and materials in terms of the current nuclear power industry here in the U.S. But we're now in a world where the demand is there. We now have to create very scaled supply chains of labor and materials and design once, build many, which again, we've seen this before, whether it's in France or South Korea. When you take a design once, build many approach, you see significant cost declines after each new deployment of a new nuclear plant, we're focused on doing the exact same thing here in the U.S.
Yeah. I want to ask you about so one of your first LPs is Gwen Shotwell, the CEO of SpaceX. It's really interesting. I was wondering if you could tell us how that came about and what does she bring to the table in this area?
Yeah. I mean, I think Gwen obviously is one of the most notable executives in any industrial company in this country. I think she's probably one of the most fantastic executives in the game today. And she took obviously one of the most difficult problems in the world, which is taking over and privatizing space deployment, and has been unbelievably successful over the last 20 years in building building SpaceX into the company it is today. And what we're also finding is that almost all of the best talent is falling out of these organizations, and we happen to be based in Los Angeles, and so some of the LA happens to have some of the greatest density of advanced manufacturing, engineering talent coming out of aerospace and defense. And so we focus very closely on backing the founders that are saying, hey, maybe I want to stay here on this planet and build the technologies and industrial solutions that are going to help us build a more resilient economy here in the U.S.
That's interesting. So, and you're based in LA. So where do you go to find, I'm just curious, I know there's this in Long Beach, there's just tons of these space companies.
Yeah.
Aerospace. Do you just go hang out there? How do you find these people?
Yeah. Well, we actually just invested in a company called Senra Systems. Incredible business. So, surprise, surprise, SpaceX team. So the founder and CEO used to run the wire harnessing program for the rocket business. What he realized when running the wire harnessing program, which just for context, a wire harness is effectively the series of wires behind any two electrified points in cars or defense or any other kind of two electrified devices. Turns out it's a $200 billion a year end market that is completely devoid of technological and kind of digital transformation, where there's an opportunity to build a completely new technology-enabled platform to design, develop, and manufacture wire harnessing. And so we were thrilled to be able to invest in that business, which they have way more demand, and they're just basically modernizing the way we design, develop, and manufacture wire harnesses. Spun out of SpaceX, unbelievable team, cranking in El Segundo.
I want to ask if you could look into the future a bit. So I know you're doing these scaling technologies that are ready today, but what are you looking at down the road? Is fusion interesting? Geothermal? What's interesting to you?
Yeah. I would say fusion is super intellectually interesting. For where we like to focus, we like to focus on technologies that we can actually commercialize today. We just tend to find that time matters in money. And if you really want to be able to drive returns, you have to be able to invest in technologies where there's a clear path to commercialization and real unit economics that we can actually underwrite to be able to scale on a dispassionate basis, just purely on their economic merit. And so while fusion is intellectually interesting, it's an area that we don't invest in just based on where we think returns are going to be in the next 10 years for our investment firm. Geothermal is actually now at a place where we're starting to see real commercialization of that technology. I mean, it is candidly probably one of the most abundant sources of 24/7 firm carbon-free power is sitting right under our feet. But we just haven't been able to necessarily get to the depths that we've always that we've needed to get to produce that kind of reliable energy. We're now able to do that in many ways, driven by the advancements we had in fracking. So literally learning from the oil and gas business around how to drill deep to be able to now apply that to the geothermal industry. So yes, I do expect the geothermal business to be a growth category within energy.
It's interesting, and I think time for one more quick one, but and maybe this is a big topic, but in order to do this, you need scientific breakthroughs, right? And we're seeing, essentially they become commercializable eventually, right? But you need to feed that pipeline. And I think there's a lot of questions now, okay, what are we funding? Is the government funding basic research like it used to? Is that a problem? Do you see a sort of the pipeline running dry at some point because of that?
Yeah, I mean, I do think it's a problem. I mean, I think to your exact point, I mean, that is the highest funnel investment that we're making as a country, predominantly coming out of our university systems. And this isn't just the investments in the R&D labs that are creating these technologies and nurturing them to the point where they can then be commercialized. But it's also, interestingly, the endowments of these universities that tend to be some of the greatest sources of capital for the investment platforms that then invest in them. And so we're in this moment right now where we're defunding the research and development that tends to be the very high funnel pipeline for our emerging critical industries. And we're also at a point where we're now making it more difficult for universities to maintain their endowments, which tend to be some of the largest sources of capital for the investment firms that then back these, back these companies and these founders. And so I do think both of those things are headwinds broadly for the continued lead that we have as a country in terms of our innovation economy.
Yeah. Well, sorry to make you end on sort of a sad note there, but I learned a lot. Thank you so much.
I'll make it positive. The positive end would be, I think that this isn't about China. I think this is an American opportunity to rebuild the critical industries that are going to drive us forward. And I do think we all have an amazing opportunity to do it.
Thank you so much.
Yeah,
Appreciate it.
Yeah, thanks so much.
Please welcome Representative Frank Lucas of Oklahoma and Eleanor Mueller, Congress reporter at Semaphore.
All right, hello. Good morning. Thank you so much for joining us for this first day of the World Economy Summit. And thank you, Congressman Lucas, for joining us from your district office in Oklahoma. Congressman Lucas is the longest serving House Republican on the Financial Services Committee. He's also the chair of its Monetary Policy Task Force. Thanks again for taking the time.
Absolutely, Eleanor. Good to be with you, and kind of during a very interesting period of time these days.
Yeah, seems safe to say. So first off, this category of our event is energy themed. You wrote an editorial last year about why the SEC should not require companies to disclose climate-related information. The Trump administration has obviously since abandoned that rule. Are there other energy-related regulations that you'd like to see Treasury Secretary Bessent take more control over as part of his effort?
I want to make sure that we have the ability to have access to the capital markets to fund energy projects. My district in Oklahoma is traditional oil and gas. We're also wind and solar. We may not have the potential for hydroelectric power, but we have a great capacity to do things, and I want to make sure that the resources are there. One of the great challenges of the Biden administration was they spent a lot of time on social policy. They spent a lot of time on environmental policy, and those kind of things don't help facilitate the market flow. They make it more complicated. So I was pleased to see the SEC withdraw their proposal. The former chairman of the Securities Exchange Commission and I, Mr. Gensler, had a long history. When I was chairman of the Ag Committee, he was chairman of the Commodity Futures Trading Commission. So our, shall we say, philosophical disagreements go back a long, long ways. But we're on the right track, and that is a very positive statement about the Trump administration. They're realistic about a number of these rules.
So they've also said that they want to oversee the Fed's supervisory regulations. Do you think that that's a good idea for the White House to have a power over how the Fed supervises banks?
Well, an independent Fed is a very important institution, and that debate, I personally believe, was settled in 1913 with the creation of the Act. And by the way, the Federal Reserve System is not owned by the federal government. It is owned by the banks, another issue that was clearly decided in 1913 in the original Act. So on the task force that Chairman Hill created as we began this session of Congress and gave me the opportunity and the responsibility to chair, that's one of the things, along with capital markets, with treasury markets, that we're looking at is the independence of the Fed. Now, some will say that this, Eleanor, is a very difficult environment to legislate in. You have a bare Republican majority in the House, a bare Republican majority in the Senate. You have all of the other things going on in the world and here at home. But I would suggest, if my Democrat colleagues agree with me, that reinforcing the Fed's independence is a critically important issue, then I think we can achieve an understanding there legislatively. By the same token, my Republican colleagues are very sensitive. They don't believe the decisions going all the way back to Dodd-Frank, and especially in the Biden administration, of having the Fed become a social policy, an environmental policy enforcer. That's outside of the scope of the Federal Reserve System. So there's a window here to make corrections and get us back on the original mission. but it's going to require some bipartisan effort, and I think that's probably one of the reasons the chairman asked me to take this on.
What specifically might that bipartisan legislation safeguarding the Fed's independence look like?
Well, remember, the Fed leadership is appointed by or nominated by the president, confirmed by the United States Senate. I think that's still a solid foundation, and that gives this president and future presidents the ability to influence policy by the people they nominate. But stepping away from the supervisory roles, especially on non-safety and soundness issues, yes, the Fed has a responsibility to make sure that their member banks and the institutions that use their services are run in a responsible, compliant, sound fashion. But there's a difference between being a good banker and being a banker who's told what kind of loans you can or cannot make in the energy sector, being told what kind of businesses you can support based on how they conduct their business activities internally. I think we can clearly define and step away from that. There are provisions of Dodd-Frank that we're looking at. But at this stage, in all fairness, Eleanor, we've had the preliminary opening hearing of the committee looking at the Fed, kind of a historic, bring everybody up to speed. We've had a second hearing looking at the Treasury market situation, bringing people up to speed. Our next hearing will be on the Treasury market side, looking at the liquidity of the markets, very important issue in recent weeks. And we'll also continue with greater discussions on the mechanics of the Fed. So I'm an old school legislator. I think this process will take us to places that we might be surprised by and may give us opportunities to make long-term changes. But my challenge, too, in the world we're in now, this instant gratification society we live in, we need to look at these rules, these laws, as though not just what will happen in the Trump administration, but the next 2 or 3 or 5 or 50 years from now administrations. And that requires a little bit of reset in the mindset of some of my colleagues.
Speaking of instant gratification, I mean, you're not having these conversations in a vacuum. The president posted on Truth Social on Monday that Powell was Mr. Too Late, a major loser for not lowering interest rates. I mean, what was your first reaction when you saw that post?
Well, the president's a very energetic, dynamic fella. He says exactly what he thinks, when he thinks it, as he thinks it. But he also is a pragmatic guy in that he will make adjustments, just as we saw more recently the comments about no, Mr. Powell should in effect stay or will stay in his role as chairman of the Federal Reserve. So the president makes adjustments, and sometimes, whether you're the executive branch or the legislative branch, the markets will drive that. And watching what's going on in the stock market for weeks now, watching what's going on in the bond markets, how we're moving all that $35 trillion in paper that the Treasury has to issue to make the government function, the president's, I responded, and I respect that greatly. But also remember, Eleanor, as you and I have discussed before, the chairman of the Federal Reserve Board is the chairman, but he has a very bright, dynamic, energetic board with him. And those decisions are not exclusively made by the chairman, both historically and in the present time. It's the whole board. So even if you were to change out a chairman, you still have a board. And I've spent enough time around the board of the Federal Reserve to know that these are dynamic, energetic, bright, strong-willed individuals. And that's probably a good thing.
Obviously, the Supreme Court has a say here, too. You know, they're expected to rule soon on Humphrey's executor, which is the legal precedent that prevents the president from firing the heads of independent agencies. I mean, do you think we'll see that ruling to have a carve-out for the Federal Reserve when we get it?
I think the 1913 law, as I read it, is very tightly written. And just because other entities might be subject to a Supreme Court ruling, I'm not so certain that it would apply to the chairman of the Federal Reserve. But we will discuss those issues in the task force hearings in the coming days and probably get down to the nitty-gritty. And I promise you, whether it's myself or my ranking member, Mr. Vargas, or the chairman, Mr. Hill, or the ranking member, Mrs. Waters, who also serve on the task force, there's a diversity of opinion. And we're kind of an intense group, too, just like the Federal Reserve Board.
Yeah, certainly. Been to enough 1 a.m. markups in Rayburn to attest to that. So you mentioned, I mean, the upcoming hearing on Treasury markets. We saw a rush to sell off Treasury bonds after Trump announced his new tariffs that caused yields to skyrocket. You said in a post on X at the time that that should provoke meaningful discussions about Treasury market structure and reform. I mean, what do you see that reform looking like at this point?
Well, first off, remember, in the last 35 years, we've literally increased the amount of paper that the Fed or the Treasury is selling into the markets by 8 times. And as a result of Dodd-Frank and a number of other actions, the number of what I would refer to as primary market makers has gone from 40-something to 20-something. So we're moving 8 times as much paper, but yet we have half the principal dealers who are managing that flow. That I'm very concerned about, and we need to look at the task force about what were the decisions made that got us to the point where financial institutions don't want to participate. And it's not just the primary market dealers, it's the SLR requirements and the ESLR requirements where we made it more difficult for all financial institutions to hold the Treasury debt. Looking at all of those kind of things as an example of the sort of stuff that we need to address. Now, the tariff issue, which has caused so much of the rumble. I'm in an agricultural district, an energy district in Oklahoma. We sell 85% of our cotton into the world market. 40% of our wheat goes into the world market. Virtually every hog in northwest Oklahoma goes to Asia to be consumed. We sit on an ocean of natural gas in my district in Oklahoma. We need to have the opportunity to sell that product, to ship it around the world, to help our friends meet their needs on a day-to-day basis. So the tariffs are very important to my people. But I would acknowledge, as my constituents would in Oklahoma, the trading practices of the last 40 years have not been fair to us. And I see why the president wants to reset the deck. He's right in that regard. But if it took us 40 years to get to this mess, it's going to take a little bit to get back from it. And I think the president understands that. But he is a man of action. Oh, my goodness.
He certainly is. So obviously, we're back to the Hill next week, whether we want to or not. And committees are slated to start voting on their own respective portions of Trump's tax agenda. What do you expect House Financial Services to advance as its portion of that package? They're directed to find $1 billion in savings. You know, the CFPB has been floated. What can we expect?
I think you'll see a number of savings achieved in the reduction of the staffing and the capacity of the various regulators. Every Republican, well, almost every Republican, is pledged to undo the CFPB. Every Republican is pledged to, or at least almost every Republican, to step the Fed back from the responsibilities dumped on them. There'll be savings. In the overall scheme of things, where we're trying to save, $1.5 trillion, where Energy and Commerce has to save $880 billion and the Ag Committee $230 billion, it's a small amount of money. But I think the people who will be affected by the changes that are a part of these resource savings processes will find it to be a positive experience. If you believe in the market, then having less interference from the federal government, which should consequently mean a little more stability and certainty, I think this will be not just an exercise, this will be a great effort on our part in the Financial Services Committee. And my friends in the political minority may not share every point of view and may not vote for any of it, but deep down inside, they're going to know it's the right thing.
Can we expect savings at regulators other than the CFPB?
I would say at this point in time, until we get to markup, I'm not completely certain as to what the chairman and will offer, and my fellow, since I'm a task force chairman, my fellow subcommittee chairman in their fields of responsibility. We'll get to that number, and we'll do it in a responsible way. And it won't surprise anybody, I suspect. This should be more of a low-hanging fruit kind of an exercise. I'm hoping.
So speaking of reconciliation, you know, we saw some Republicans weigh whether to reduce their federal share of the Medicaid expansion. I mean, is that something that you'd be on board for with Oklahoma?
I think that reforming Medicaid, which is the program that applies to people under 65 below a certain income level, is probably one of the necessities because it's just out of control. Now, there are a lot of unique issues in various states. In Oklahoma, we are one of, I think, 3 states where out-of-state entities came in and used the initiative petition process to bring a vote of the people and basically say in our state constitution that if the Fed portion of spending is reduced, and sometimes that's as much as 90% in certain states, that the state will automatically pick that up. At the time this passed, I don't think my state leadership really thought through what the potential impact was going to be. But in the case of Oklahoma, if the E&C Committee, Energy and Commerce, I should say, achieve their $880 billion in savings, a big chunk of that has to come out of Medicaid. And in Oklahoma, as an example, the state will be compelled to pick up what the federal government has not paid for. Now, when Uncle Sam was paying for 90%, it was awfully easy on the state level to be very enthusiastic about these programs. But if they have to put skin in the game, and not just Oklahoma, but across the country, it's going to be a fascinating process, not just reconciliation, but implementation. Get ready for some real excitement out on the state level. And I believe in state and local government. I have faith my friends in the legislature and my governor in Oklahoma will do the right thing. We'll just see what the right thing is.
Well, like I said, I mean, you are the longest serving Republican on House Financial Services. Do you expect to stick around past this Congress?
I think I have an obligation to my constituents to stay through the Trump experience, and we'll see where the world takes us in the next administration. This is a 2-year term, and the good folks back home have the ability to change their mind every 24 months. But by my tenure and my focus, I'd like to think I've been a good reflection of the people of the 3rd District of Oklahoma, and that they will give me the chance to continue to work through these issues. Someday, we're going to have a large enough Republican majority to be functional, not to have to do things through reconciliation, because as you and I again have discussed before, Eleanor, with anywhere from a 1 to a 4-seat majority in the House, a 3-seat majority in the Senate, conventional legislating is extremely difficult, and many of the big issues are going to go not just the budget savings for tax relief and border security and all those things through this first reconciliation bill, but many things are going to have to go through reconciliation, whether it's 1, 2, or 3 reconciliation bills in this calendar year. And I know anyone who's aware of reconciliation is just taking a deep breath, but the hard stuff will probably pass in that fashion. I'd like to get to the other side when we can go back to normal legislating. I believe in regular legislative order.
All right, well, thank you so much, Congressman. That's all the time we've got today, but thank you, everyone in the audience, for joining us, and enjoy the rest of your recess.
Thank you, Eleanor.
Ladies and gentlemen, our program is about to begin. Please welcome Rachel Reeves, Chancellor of the Exchequer of the United Kingdom, and Andrew Edgecliffe Johnson, CEO Editor at Semaphore.
Hello, welcome. Thank you very much for being here, and thank you particularly to the Chancellor for joining us. You're in charge of the world's 6th largest economy. You are also MP for Leeds West, an accomplished chess player, author of a book on female economists, and you've worked in both the private sector for HBOS and as an economist for the Bank of England. And I gather that that job brought you here to Washington for a period 20 years ago to the British Embassy. So welcome back.
Thank you very much, Andrew. It's great to be here.
You're also the second longest serving G7 finance minister after less than a year in office. So you get to pull rank at the World Bank and IMF meetings this week. But let's talk about this interplay between London and Washington right now. The UK economy that you oversee actually has just had some better than expected numbers. The February GDP figures were unexpectedly strong. But as you said, after Liberation Day, after President Trump announced his tariffs, the world has changed. So let's dig into how it's changed. I believe you're due to meet Treasury Secretary Bessent while you're here. Let's start with the trade deal the UK is hoping to strike with the US. Right now, there's a 10% tariff on most imports from the UK, 25% tariff on imports of cars, which are the largest, UK's #1 export to this country. What cards does the UK hold going into this negotiation?
There's certainly a deal to be done between the UK and the US. I very much understand the concerns that the US has about countries that run large, persistent trade surpluses with them. But the UK is not one of those countries. We have balanced trade between our two countries. There are 1 million British people working for American firms, and there are 1 million Americans working for British firms. So our economies are very closely intertwined. And certainly what we hear from the US administration is that they are keen to do a deal with the UK, reflecting the closeness of that relationship. And as Chancellor and this Labour government very much believe in free trade, also believe it needs to be fair trade, and that's why we do understand some of the concerns that the United States has. We are willing to reduce trade barriers in the UK, those trade barriers that do exist, and we want to build on the relationship that we have. And then beyond tariffs, I think that there is much more that our two countries can do together, for example, on a technology partnership, building on the close relationship we have on security and national defence. I think we can go a step further, building on the strengths that both the UK and the US has in scientific enterprise, in moving to that next stage of a technology partnership. So, of course, we want to address the current challenges that we face with tariffs, but I think we should look beyond that as well. This isn't just about sort of damage limitation, it's also about what the next step is.
I want to get to that. Just can you give us any more detail on those barriers you think the UK could remove? Where do you think there's room for compromise without damaging British industry?
There are still tariffs both ways, even before Liberation Day in April, between our countries. I would like to see those tariffs and non-tariff barriers reduce. I think that's in the interest of both our economies, and because we're starting from a position of balanced trade, I think that can be a bilateral process between our two countries to remove those remaining trade barriers that do exist. And I think if we work on that basis, there is a deal to be done that will benefit industry both in the UK and the US, and jobs in both of our countries as well.
So before we get to the kind of potential opportunities you see, what are you having to do right now, absent a trade deal or pending a trade deal, to soften the potential blow to the UK economy if nothing is resolved?
So even before the imposition of tariffs, the government in the UK are very much focused on growth. When we were elected last July, we said the #1 mission of the incoming government was to grow the economy, and we are tackling some of the sort of underlying structural reasons for why our economy has not achieved its full potential. because despite the fact that we are a strong economy with huge strengths, we haven't grown or seen the productivity improvements over the last decade or so that we should have done. And so one by one, we are trying to push out the way those barriers to growth. So significant changes to our planning system to make it easier to build in Britain, whether that is the housing we need, but also maybe more substantially the digital infrastructure, the transport infrastructure, and the energy infrastructure. Reforming our regulatory system so that we're regulating for growth and not just for risk. That's really important, and we've changed the remit for some of our key regulators, including in financial services, to regulate for growth and reduce the administrative costs of regulation. Also, substantial reforms to our capital markets, particularly around how our pension system works, so that we are driving the consolidation of pension funds, so we have a smaller number of bigger pension funds that can invest in scale in some of our startup and scale-up businesses, because we've got some fantastic spin-outs from our brilliant universities in the UK, but the challenge they have is raising money in UK capital markets. So all of those reforms are about growing the economy, and the message that I'm coming to Washington with this week, and that I'm going to other countries around the world with, is Britain is open for business, open for trade, open for investment, and we are changing the way our economy works to really attract the brightest and the best and fast-growing businesses.
So we've got a lot of CEOs in the audience here today, and I'd like to dig into that. What is your message specifically to international business right now about the case for investing in the UK? They've got a lot of options. What is it about the UK under this government that is different?
Well, I'll go back to where you started, really. The world has changed, and we can see that all around us. And what the UK is able to offer is political, financial, economic stability in a world that is very volatile at the moment. I think that is a huge plus for the UK, and we are open as a country for business, trade and investment. And we've taken on board, as a new government, less than a year in, the feedback from businesses, both domestic and international investors, about the things that hold back investment or delay investment on regulation. And actually, I flew out yesterday, and I flew from Heathrow, where many of you would have flown into and out of before. This government in January announced that we're backing a third runway at Heathrow. Heathrow are going to come forward before the summer with proposals for that third runway, and we are determined within this Parliament, so within the 5-year term of this Parliament, to see that planning application granted and to see spades in the ground. So I think that's about the seriousness of the intent of this government. We're also working with business to join up two of the best universities in the world, Oxford and Cambridge, with a new corridor between those two great cities to enable them to expand and grow, particularly in areas of tech and life sciences, which are huge UK strengths, but again are held back by those small cities not being able to expand. So a train link between those cities, connecting the towns and cities in between, it is about trying to attract more investment into Britain in some of those fast-growing sectors that are highly competitive, but where the UK has huge strengths.
Incidentally, do you think what's going on here in the tension between the administration and the universities in the US is an opportunity for Britain's university sector?
Well, Britain already has, I think, 4 of the top 10 universities in the world are in the UK. That's a huge strength. And alongside the US, we've got the best universities in the world with some of the best scientists and researchers. And we do want to attract talent. And I won't make any apology for that from countries around the world, including the US. Our universities...
Is there a strategy for attracting more of that talent?
I think some of it will happen organically. We have great strengths, particularly in some of those sectors, life sciences, clean energy, and the tech space as well. The capital markets reform that we are embarking on at the moment is also about helping some of those start-up and scale-up businesses coming out of our top universities stay in the UK because they can access finance in the UK. And we're working very closely with the London Stock Exchange Group and with the Financial Conduct Authority to help businesses list in the UK and make that more attractive. So there is a number of things we're doing, both to hold on to homegrown talent, but also attract that talent from around the world with a concierge service to help people who are looking to relocate to the UK and help our universities secure some of that global talent.
Okay. So what's your broader agenda at the World Bank IMF meetings this week beyond the US-UK negotiations?
Well, obviously, this is the 80th anniversary of some of those institutions. As a governor of the International Monetary Fund, I want to strengthen those institutions. But look, this is an important week for me as Chancellor of the Exchequer to spend time with my counterparts from around the world, in G7 and the G20, but also in the wider meetings. And rightly, there's a lot of focus on the trade deal between the UK and the US, and that is crucially important for all the reasons that I've already mentioned. But we were also elected on a platform of resetting the relationship between the UK and the EU, because we want to make it easier for Britain to trade with countries all around the world. We are close to finalising an investment and trade agreement with India, one of the fastest growing economies in the world. And so this week is an opportunity to build on some of those links and set us up for those closer ties, which really sees Britain as a sort of a bridge between continents. We benefit from our time zone, our language, and our connections with countries around the world. And one of the opportunities this week is to build on that.
And you've talked about making the UK a business hub for all of Europe. How fundamentally do you think has the tariff shock, the events of the last few months, changed the UK's post-Brexit relationship with the EU? And are you expecting much deeper integration from here?
Yeah, so look, we left the European Union, it will be 9 years ago this June that the British people voted to leave, and that sort of ship has sailed. We're outside the customs union, the single market, but we want to deepen and strengthen our trade relationships, but also our defence and security relationships with our European colleagues. And that's why we've got a summit between our countries on the 19th of May to really remove some of those barriers that are making it difficult for businesses to trade. So looking at things like the veterinary agreement between our countries, the mutual recognition of standards, a number of areas where we think we can reduce some of those barriers. And it's all part of the vision, really, that we have for the UK economy, which is an open trading economy, open to countries all around the world, where the best talent can come, where businesses can start and scale up, can access the finance that they need to grow, and where businesses can also access the talent because of our great universities and education sector. So huge strengths in the UK economy. We're playing to those strengths, acting in the national interest, but an outward-looking government, perhaps in a world where there's less of that these days.
Right. Can I follow up on your point about the defence coordination with your European counterparts? Ahead of this summit in May, what's the conversation you're having about how to coordinate what looks like potentially quite a meaningful increase in defence spending across the UK and the EU?
Yes, so we announced just a couple of months ago now, the biggest sustained increase in defence spending in the UK since the end of the Cold War, taking our defence spending up to 2.5% of GDP, above the NATO 2% target. So that's a substantial increase. We are starting that this financial year with a £2.2 billion increase in defence spending this year, with a particular focus on investing in defence innovation. So supporting particularly tech companies who want to enter the defence space. As a country, the UK has been one of the staunchest supporters of Ukraine, and that support has involved a number of things, of course, direct financing, but also access to UK defence innovation and technology. And we want to build on some of those strengths and advances we've seen in the last 3 years to improve the availability of technology for our armed forces, and also help British defence companies win contracts around the world, as other countries too are looking to increase their defence spending. And we want to do that in partnership with our European allies as well, because we all recognise the need to step up and better protect our own continent from the aggression of Russia. And in Europe we can see that much more up front and close and personal than perhaps you can from the United States, but countries across Europe are looking to increase their defence spending. You see that in in Germany, particularly in Poland, which of course is on the front line in Eastern Europe, and the UK want to play our full part, but not just going it alone, but working in partnership with European allies to get better value for money for the defence spending that we put in through a proper industrial strategy, standardisation of procurement, so that we are working in partnership because we have a shared objective in Europe.
And how are you going to pay for it?
We've reduced what we're spending on international development. I think that was the right decision. So the increase in defence spending in the UK is fully funded by a commensurate reduction in our overseas development assistance. That was the right decision given the challenges that we face as a country.
Going back to where we started, the growth agenda you came into, which I think was very well received by a lot of businesses, and then the initial months they were less certain that they were seeing the traction on it. What do you think has really fundamentally changed so far in your 9 months or so in office in the UK economy when you look back at the economy you inherited, where it stands now?
It's a relentless focus on growth. So, the previous government, Prime Minister and Chancellor were very much focused on tax and spend policies. We are relentlessly focused on pro-growth policies. So whether it's the planning reform, the regulatory reform, the capital markets reform, but also all built on this platform of stability, because stability has got to underpin any strategy for growth, and the political, the fiscal, the financial stability that this government has brought, a big political majority, a mandate to grow the economy, means I think that people can have confidence that we're going to deliver on this agenda, and we've got the political will and the political majority to deliver it.
Right. Finally, are you going to be conducting any trade negotiations over a chessboard?
Well, I might win some then.
Well, I wish you luck this week. Thank you very much, Chancellor Reeves, for joining us today.
Thank you.
Thank you.
Please welcome Dominic Del Oso, Junior President and CEO of Expand Energy, and Charlie Gasparino, Senior Correspondent at Fox Business Network.
Well, it's nice they saved me the introduction.
It's good.
Okay. Are we in a recession?
I don't think so. We could be before long, but I don't think we are right now.
Give us the dynamic from you can surmise a lot from the oil and gas markets. I always believe. It's a great indicator, macro indicator of the economy. What would you be looking at to suggest that we're heading that way? Oh, but we are heading that way, right?
It's possible. I'm not all the way there yet. So I think you look for industrial activity, you look for demand for the more marginal parts of the energy demand cycle. Our company produces primarily natural gas. And right now there's a big secular demand growth of natural gas out of the US because we are creating all this new export capacity. So if we're going to have a recession that's going to be a problem for natural gas in the US, it really has to be a massive worldwide recession that pushes down demand for gas in a way that's pretty hard to fathom.
Although you guys are an outlier a little bit in the sense that we do have demand that's, I guess, baked in, keeps a floor on stuff because of AI and crypto, correct?
Correct. There is a bit of a power demand. That part of energy demand is pretty inelastic. Electricity for residential, electricity for a lot of uses, pretty inelastic. It becomes seasonal. There's a lot of incremental natural gas demand in the winter, obviously, when it's colder. But that seasonality still is somewhat inelastic, weather adjusted.
What is the, how much capacity does AI and crypto add? Can you add it to your bottom line? Do you know where it is?
Well, of course, we don't have the crystal ball. We'd like to think we do, but we don't. So let's put it into context this way. The U.S. produces about 105 BCF a day of natural gas today. And we think that AI-driven electricity demand will result in an incremental 5-ish BCF a day of demand growth for natural gas before the end of the decade. On the other hand, we think there's 15 BCF of growth coming from incremental export capacity for LNG. So the AI story is really important.
but it's about a third the size of the LNG export story.
Interesting. Tariffs impact you guys?
They don't seem to be impacting us a lot at the moment. Yeah, by the time you get gas on the water, it's pretty fungible. There's a lot of trading that happens. And again, you have each incremental molecule of gas that goes on the water is filling what is currently unmet demand in the world. And so there's just a huge shortage of energy that this incremental export capacity is filling. So
you take China out of the mix, which at least as of yesterday, maybe today it's different. I don't know. I haven't read the headlines. Let's just say they're out of the mix. How does that impact you guys?
It really doesn't. So what will happen is as cargoes get put on the water, they get traded. Each cargo of LNG that gets put on the water is likely to get traded anywhere from 6 to 10 times before it's created until it's actually delivered somewhere. And so all of that trading will allow for everyone to feel good about where they're buying gas from and where they're not. And you've already seen that cargoes that would have otherwise, may have otherwise gone to China are getting sold into Europe or other places. And so that trading happens and it becomes fungible.
So you have the ultimate business. Everybody should buy your stock. You know what's coming
I think
next.
so, yeah.
Why is it trading below the average analyst estimate? I mean, someone's not buying it.
Yeah. Actually, I'd like that there's an analyst estimate average that's higher than our stock price. I think that shows that there's expected growth. We, within the last month, hit an all-time high for our stock. And to then have target prices that are well in advance of that, I think is pretty encouraging. And that's really about this secular growth for natural gas. We've just completed a merger in the last year. We took Chesapeake Energy and Southwestern Energy, created Expand. We're the largest natural gas producer in the United States. The demand growth for natural gas is really not debated. And so we will be a big beneficiary of that. We've taken a tremendous amount of costs out of the system with the synergies of this merger. And we've put ourselves in a really great position to benefit from all this demand growth. So we like the fact that there is an expectation of growing stock price.
Or something's wrong. Is it saying something's wrong?
I don't think it's saying anything's wrong. I think we are seeing that demand growth happen right now. It is occurring during 25, 26, 27. And so there is an expectation that we will be delivering more volumes to market at higher prices. Our cash flows are going up.
You know, I did a little research on you, and to the person, said you're an excellent CEO. Okay, I don't say that, you know, just off the top of my head.
You didn't talk to very many people, I guess.
No, I did. I mean, I just, you know.
That's nice.
Thank you. You have a very good reputation as a great technical, great hands-on CEO. How did you get here from being a banker? Was it like, did you, I mean, you initially sold your soul coming out of college.
Right.
And then you kind of thought you'd...
Went through a recovery program.
Right. Detox.
Detox, yeah. So I joined the company 16 years ago, and our company's been through a tremendous amount of distress. I joined the Chesapeake Energy side of what is now Expand. Chesapeake Energy has played a really important role in the shale development in the United States, really led the shale development into what it is. And as a result of that, had a pretty interesting history of really rapid growth that was fueled by a pretty heavy balance sheet load. We had a lot of debt. I spent 11 years as CFO, most of that time trying to work that debt balance down and reorganize the company in normal course. Ultimately, during COVID, we filed bankruptcy. And then post-bankruptcy with a clean balance sheet and an ability to have a renewed strategy into this really great macro backdrop where there is this secular demand growth for gas, our board asked me to take on this role, and it's been a lot of fun.
And then you did the merger.
And then we did the merger.
What was the spark for the merger?
So we have a great portfolio of gas assets across the Appalachian Basin and the Haynesville Basin. We're really the only large player that has a position in both. Southwestern had a position in the Haynesville as well. The Haynesville being a really important strategic gas asset for the United States because it is so close to the export capacity in Louisiana, but is a higher cost basin to produce from than Appalachia. We wanted to lower our cost in the Haynesville. And we are delivering $500 million of annual synergies.
Oh, absolutely.
That merger.
Absolutely. The Trump administration wants you to keep drilling. Was it drill, baby, drill? Does that bump up against reality at some point price levels?
A little bit. So what I like about the way that conversation has evolved is Chris Wright and Doug Burgum, who jointly lead the National Energy Dominance Council as the Secretary of Energy.
Dominance?
Yes. Secretary of Energy and Secretary of the Interior, they will describe that drilled baby drill really means build baby build. And with that, they're talking about infrastructure. If we have better infrastructure in the United States, you will see the oil and gas industry increase supplies, because that would mean we can deliver energy supply where and when it's needed more effectively, and we can earn a return on our capital.
And why don't we?
Why don't we have infrastructure?
Yeah.
I mean, the permitting challenges of building anything in the United States over the last 20 years have just gotten worse and worse. We don't build electrical transmission lines, let alone pipelines.
Yeah, yeah. No, I mean, everybody thinks infrastructure is roads and bridges, but it's more complicated than that these days.
It is.
Does the Secretary of Energy understand this challenge?
He understands it maybe better than any other American.
Really?
I absolutely believe that. He is a very intelligent guy who has studied energy markets.
We're talking, what is...
Chris Wright.
Chris Wright, that's right.
Yeah, has studied energy markets his whole career. He was an MIT engineer, and this is what he's based his life on.
And so where do you think he starts with this, on this infrastructure aspect?
The whole industry is talking to the administration about pipelines, about the capacity of the electrical grid. Infrastructure has to be the right infrastructure in the right places. I'll give you an example. We all talk about the growth in generation capacity that's needed to meet the demand for AI. We need more electricity in the U.S., that's pretty clear. And it's exciting. That's growth, and that's productivity for GDP. AI is going to be an incredibly powerful driver of our country's GDP. We have to have the right energy to do it. Well, we have currently an installed generation capacity in the U.S. of 1,300 plus gigawatts of power. There's about 10% incremental gigawatts under construction today. The problem is 84% of that is renewable.
Huh.
And there isn't a data center on the planet that can go sign up for incremental generation capacity from a renewable source. It doesn't work.
It doesn't work. It's
doesn't work.
Unreliable.
Yeah. I think it's great. Go ahead and build it. That's fine. But it's not reliable for things like data centers for base load demand. And so, for example...
You can't use solar powers for...
You can't. You can't. Not until we have dramatically advanced battery technology to store enough solar and wind. And even at that, you're still going to have an overall capacity factor that's going to be challenged. The capacity factor, so if you have a gigawatt of renewable generation, it'll run on average at about 30% capacity for a year. So that means you'll get 300 megawatts out of a gigawatt of installed capacity.
I don't know.
That's not very effective. It means 1/3 of it works.
Okay, gotcha.
Is effective for you.
That's interesting. Do you see nuclear power being a competitor of natural gas? Because, I mean, there is some, now with Trump in there, deregulation, nuclear power is starting to make a comeback, so to speak, at least, rhetorically.
Yeah, in its most bare sense, nuclear power absolutely competes with natural gas because they're both baseload. But I don't really see it as competition that I'm anything other than excited about, because we need it all. And just as a citizen of this country, I want to see a lot of nuclear built. It's a great solution. I want to see the costs come down. I want to see it have effective regulation so that we have confidence in where it's being built and how it's being managed. And that's all very possible.
That wouldn't put you out of business, though?
I mean, if it were wildly successful forever, theoretically, yes, and I'll take that. That's great. We are so short energy in the world that I think we need it, and I welcome it.
At what price point do you start losing sleep? I mean, we're at $3 now. You were explaining it's more to that.
Yeah, so last year was a lousy price environment for natural gas. We spent, the average for the year, Henry Hub prices, was like $2.27. We don't make money on new drilling at those prices. So I don't know that I lose sleep, because the great part about commodity markets is that low prices cure low prices. So when you
explain that,
yeah. So when you have low prices, we all stop drilling. We all stop bringing new supply to market. Therefore, you have less supply to market, and prices go up. Commodities are in decline every day that you don't add something new. Right? A well is always declining. So the aggregate of all the production in the U.S. is in decline and requires new investment just to hold steady. When you pull back that new investment, you see decreasing supply. Low prices result in decreasing supply. We saw that throughout 2024, and now in 2025, we need to grow it again.
You were going to increase capacity in 25 and 26.
Right.
Still on track for that?
Absolutely.
Really?
Yeah, we made that decision based on our view of a long-term cycle, 2 to 3 year look, and we made that decision on a long-term cycle price around $3.50. And right now, the prompt price for gas is at $3, and the 2026 average price is above $4. That seems to hold. The fundamentals are still the same. They really haven't been impacted by the recent volatility.
You want to achieve, or your company wants to achieve carbon neutrality, so to speak. Why would you care about that right now in this environment? I mean, ESG is on the way out.
Yeah.
You know, the Trump administration is like, you know.
Yeah, look, I think environmental stewardship still matters, and we should all endeavor to have as clean of a business as we can have. Given that we produce mostly natural gas, and within that mostly dry natural gas, meaning we don't have natural gas liquids, which involve complicated tanking systems that have to ventilate and all that, we have a relatively straightforward path to creating a very low carbon molecule. And we think that's valuable. We know it's valuable to the people that buy LNG from the U.S. They tell us, they pay for it.
Really?
Absolutely.
Are investors asking for that out of you when you go meet with BlackRock? I mean, BlackRock is the one that usually. So they're still pounding the table on it?
Define pound the table. I would just say that they have cared and they still care. I would say we probably spend a little bit less time talking about it, primarily because if you look at the emissions factors across the industry, we sit at the very, very low end because of the assets that we manage and the efforts we've taken over the last 15 years to reduce emissions.
Price of oil right now, you follow that obviously.
Sure.
What do you think about those markets these days? They're signaling worse than yours. I mean, and there might be a better barometer of a sort of forward-looking economic outlook.
Yeah, I think there's two challenges to oil markets today. I think there's an unknown tariff impact that people are trying to figure out on the margin. A recession means something negative to oil markets, and where are we going to be in that spectrum? The second is there's clearly a lot of geopolitical pressure around what the U.S. is going to do, what Saudi Arabia and Israel are going to do with respect to Iran, and what OPEC will do in response to all of it. OPEC Plus has held as a extension of OPEC since COVID, but you see in all the rhetoric coming out of Saudi Arabia some fraying or frustration of that. So I think there's the two big features there that are creating a lot of uncertainty.
Any macroeconomic forecast a year from now? Where do you think we're going? Is it too hazy until we figure this out?
Yeah, it's a little hazy in the near term. I think there's the big challenges, of course, are where are we going to land on tariffs, and does it push us into recession? Is that recession going to then create a good outcome? I think that's still possible if we, in fact, do go into recession. We still have a lot of challenges around our overall country's balance sheet and refinancing our debt. So interest rates are probably going higher. But in order to make all of that work, if we have a growth agenda...
So you think the market's going to push the 10-year and the 30-year higher?
I think that seems likely to me. But I think we could have an economy that's growing into that feels pretty good for our population. I don't think that's necessarily catastrophic.
Interesting. You think the Fed's going to cut rates this year?
Can't predict that.
You covered everything I was going to ask. And you know what's great about you is that you're the type of CEO that wants to get off the stage fast. And by the way, his PR people taught him that. I just spoke to him. So, I'm done. You want to say anything else?
No, look, we're excited about the role gas is playing in the world today. And we're excited about the role it plays both domestically and internationally. It is super strategic that the U.S. has massive energy resources. And the problem that we have, the challenge that we have, is connecting those energy resources to the markets where they can make a difference. We have energy poverty in the U.S. We have energy poverty internationally. It all gets solved with infrastructure. We have to embrace the building of things so that we can have a growing economy, so that we can get ourselves through the challenges of refinancing our debt and creating more opportunity in our economy that can be fueled through AI.
Well, how do you get now that you brought that up, how do you get the Trump people to really focus on that? I mean, they seem to be all over the place. That should be a key.
I actually think they are focused on it. I mean, there's a lot of challenges in trying to understand each of the day-to-day steps that are taken, and I'm not nearly smart enough to understand and follow all of the moves. But I do think that they understand we need a growing economy. We need to invest in this economy to grow effectively. And that requires infrastructure. And I talk about pipeline infrastructure mostly because that's the closest to our business. We need lots of infrastructure. We do need roads and bridges,
right?
But we need electrical transmission lines, and we need all sorts of things that will facilitate growth in our economy.
When was the last time you talked to the Energy Secretary?
2 weeks ago.
What did he say?
He said, my job is to encourage growth in this country.
And infrastructure, did he mention the words?
Oh, absolutely. Constantly.
All right. We'll end it there. Thank you.
Thank you.
Please welcome Senator Chris Van Hollen of Maryland and Margaret Carlson, Washington Editor-at-Large, Semaphore.
Hello, Senator Van Hollen.
Margaret, it's good to be with you. I wish I was with you in person, but
so
good
do
to connect.
So you're back from your vacation in Margaritaville, and now you're on vacation, so he can't be with us today, but nonetheless, we have him by Zoom, the miracle of Zoom. So we had some news, so before we get to El Salvador, that Senator Durbin is not running for re-election. So it probably doesn't open up a Republican opportunity for a seat. The Democrats usually win in Chicago, but what's your prediction? Who will win that primary? Mr. Pritzker?
Well, Margaret, let me just say at the beginning, since this is breaking news and I just learned it, that Senator Dick Durbin, in my view, has been just a great United States Senator. He's been a person of principle, standing up for equal justice. He did that when he was chairman of the Judiciary Committee, and he's standing up for the rule of law now as ranking member under terrible circumstances. And the short answer to your question is, I have no idea who's going to win the Democratic primary for his replacement. But I do agree with your assessment. This is highly likely to remain a Democratic Senate seat.
And there's a generational change going on, it seems. Jeanne Shaheen is retiring, Tina Smith. And so maybe you could move up in the leadership. You can make other news today. And, you know, there is room for the younger, and I call you younger in terms of the Senate, where we have 80 and 90-year-olds. So, but I won't ask you to comment on your own ambition. So let's go back to El Salvador, where you got to meet Abreu Garcia at last, just as you were about to leave. And how did you find him? And what can you tell us that we don't know from the news? What was he like?
Well, he was clearly traumatized by this experience, being abducted off the streets of Maryland, sent to, I believe, the Baltimore Detention Center, then Texas, then handcuffed and shackled, put in a plane where he couldn't see out the windows, and landed in El Salvador and was taken to the most notorious prison in Latin America, CCOT. So he was clearly traumatized by that experience. His main questions related to how his family was doing, and I told him they sent their love, and he said that gave him strength. He was also thrilled to know that his union and brothers and sisters at the sheet metal workers were cheering him on, and others around the country who recognized that this is not a case about just one man, Abreu Garcia. If you take away the constitutional due process rights of Abreu Garcia, you threaten those rights for everybody who lives in the United States. And that's why the courts have been so crystal clear, Margaret. So the other thing I can report is he knew nothing about that. He's been in a total news blackout and unable to speak to anybody, his wife, his lawyers, before I met with him. And my understanding is since I met with him. So that's why we all need to keep focused on this case, because it is about all of us at the end of the day. And the Trump administration continuing to ignore court orders. In fact, the district court judge just yesterday said that they were engaged in bad faith and intentionally refusing to cooperate.
So you did get him moved from the dungeon to a room with a view, apparently. I think it was called a room with a view, like Virginia Woolf.
Yeah. So, Margaret, I actually don't know if the room has a view. He was moved actually a number of days before I arrived to a detention center that's not the most notorious detention center in El Salvador or Latin America. But he is still very much confined, and he's also still very much in a news blackout. And people, if I wanted to call him or his wife wanted to call him today, you can't get through. So better conditions. But this is a moment, you mentioned Margaritaville coming in. You're absolutely right. So the Bukele government tried to stage this look like we were both, sipping margaritas, which of course was a big, big, big lie. And Donald Trump and Bukele are lying through their teeth. They're trying to change the subject entirely, right? And so we need to be focused on the main issue despite their distractions. And that is what the Fourth Circuit Court said the other day in a 3-judge panel where the lead judge, Wilkinson, was appointed by Ronald Reagan, who said, this is not one of those difficult cases. This goes right to the heart of the issue of due process and constitutional rights. So we need to recognize that all the Margaritaville and all the Trump tweeting is a huge effort to change the subject. We need to keep on the subject at this moment.
So, Senator, I wrote down part of Wilkinson's, what he said about this case, and there's a warning in there, and I want to know what you think about. The branches come too close to grinding irrevocably against one another. The executive may succeed for a time, but over time, history will script the tragic gap between what was and all that might have been. This case is their unique chance to summon the best that is within us while there's still time. How the Justice Department keeps writing back to the courts as if the courts haven't said anything to them. Like they just say the same things over and over again, so that the definition of facilitate is still up in the air to them, where each court has said facilitate is a verb. You must do something. So where do you go from here? Because that court decision, Wilkinson, one of the most conservative judges in the land, is warning us that we're coming to a collision. We're on a collision course between the executive branch and the courts in this case. In other instances, but in this case.
Right. I think we should pay very close attention to what Judge Wilkinson warned about. I do think we're at that moment, that tipping point. I mean, and this should have been an easy one for the Trump administration, because they admitted in court, right? They admitted in court that they had wrongfully detained and deported him. They called it an administrative error, but instead of saying we're going to fix the problem, what did they do? They reprimanded the lawyer who told the truth in court, and then put him on administrative leave. In fact, I'm told he may be fired right now. So that is why a 9-0 decision by the Supreme Court to facilitate, as you said, that's a verb. They need to take action. When I met with the vice president of El Salvador, it was very clear that the Trump administration was doing nothing to try to get Abrego Garcia out. In fact, the vice president of El Salvador said that the government of El Salvador, have no basis to hold him, no legal basis. In other words, they're not charging him with any crime. Nobody has charged him with any crime. They say they're holding him because they're being paid by the Trump administration. Right. In other words, this is a fee-for-service deal. So for the Trump administration to say, they can't do anything about it, is just a big lie. And that's why the courts are so frustrated. I think, Margaret, I don't know which case it's going to be, but at some point, the courts are going to have to hold the Trump administration in contempt and with sanctions. Nobody wants to get there, but apparently Donald Trump or someone in the White House, maybe it's Steve Miller, is interested in reaching that point. Because my view, we're already in a constitutional crisis. They're clearly if you listen to the judge right now, willfully and intentionally disregarding the court.
So in the meantime, what can you do? What can the Senate do? Hold up judges? I mean, do you feel helpless, or do you think that there's, now that you're back, other than, by the way, congratulations on the full Ginsburg. For those of you not old enough to remember, that's 5 Sunday talk shows in a row. What can you do? You can speak out, and you went there and you have, and what else can be done?
Well, there are a couple things here at home, and then there's something with respect to El Salvador. Here at home, as I mentioned, the Trump administration has entered into this $15 million, deal where, El Salvador will just take people, including people who are illegally deported from the United States. Ultimately, Congress will have a say on the appropriations bills, and I will not support one penny to go to El Salvador to help keep Abrego Garcia illegally detained when the courts of the United States, including the Supreme Court, say that his constitutional rights have been violated, because that is a threat to all of us. So that is one thing. The other is we can put pressure on the government of El Salvador. I mean, this is $15 million. That's not a lot of money. El Salvador is trying to strengthen its economy, and I certainly urge Marylanders, but I would urge every American, because their constitutional rights at stake, vote with your feet. There are lots of places to visit in Central America. Costa Rica is a beautiful place. You don't have to go to El Salvador. In Maryland, I've asked the heads of our state pension funds to look and see whether we have any holdings in companies that do business in El Salvador. This is obviously not a huge area, but again, $15 million isn't a lot of money. So we can press to change that equation. I think President Bukele needs to understand that he should focus on branding El Salvador for technology.
Right.
As
Not
you know,
prisons.
he made Bitcoin, he made the legal tender that got a lot of attention. That's what they should focus on, not being the place with a notorious prison where they take people who are unconstitutionally seized from the United States in violation of their due process. And every American should care, because if this man's constitutional rights continue to be violated, everybody's rights can be violated. I keep saying I'm not vouching for Abrego Garcia, the man. I'm vouching for his constitutional rights, because all of our rights are at stake now.
Right, for due process, not for any individual, but for all of them that could be snatched up and sent away. So, Senator, just for a moment, what we have left, the audience here won't breathe a word of it. What is your caucus saying at your weekly lunch? How do they feel about it? Do they feel helpless? Gavin Newsom is saying, oh, on this immigration business, Trump has just lured Democrats into their trap. He loves the subject to be immigration. Chuck Schumer, who's coming later today, says, oh, let's just roll with it. Trump will do himself in. So when you're behind that closed door, and by the way, we're off the record here, audience, what are you and your colleagues talking about?
Well, first, let me say, Margaret, I think there's never a wrong time to fight for the Constitution and due process. And I do believe if you're a libertarian or a conservative in America, or anybody else, as Judge Wilkinson said, you have a stake in the outcome of the Abrego Garcia case with respect to the due process and Constitution. So I don't think there's ever a bad time to fight on that. And I really think, what Americans want are people who are going to focus on core issues and not have their finger to the wind. I believe we need to also point out what I call the great betrayal. I mean, Donald Trump said on day one he was going to bring down prices. He was going to be there for, the forgotten American, when in fact, everything he's done has been focused, number one, on not bringing prices down, but on serving the interests of people like Elon Musk, who were sitting right behind him on Inauguration Day. That's who he's delivering for right now. And the result, as we see, is an economy in total chaos. We have his tariffs going zig and zag, and obviously talking about, firing Jay Powell one day and not the other day. this is a self-inflicted wound on the economy, and it is hurting working people. I met with some Maryland farmers recently who were being hurt by the tariffs, who were being hurt by buzzsaw cuts to Department of Agriculture programs. So we need to focus, Margaret, on the fact that Donald Trump is betraying those people who he promised to be standing up for. And the next chapter, and you asked about what happens in our caucus, the next chapter will be this Republican effort to extend tax cuts that disproportionately go to the very wealthy and big corporations, maybe a lot of people who are watching today, but at the expense of everybody else in America, right? They're talking about deep cuts to Medicaid, to food and nutrition programs. My view is that we should have a clear alternative that delivers tax relief to working Americans, and so that we deliver something that Donald Trump promised, but continues to disregard his own promises.
So to end on a slightly positive note, I think Elon Musk and his chainsaw will be leaving soon, and Washington, I think at least the people who work there and care about it and will be better for it. Senator, thank you for taking time away from your real vacation, not the one in Margaritaville, to come and talk to us. Thank you.
It's great to be with you. Thanks.
Please welcome Andrew Ferguson, Chairman of the Federal Trade Commission, and Alana Shore, Senior Washington Editor at Semafor.
Chairman Ferguson, thank you for joining us today at the World Economy Summit.
Thanks for having me.
You lead the agency at the intersection of some of the hottest topics right now, breaking up big tech, monopolies, and free speech. But I want to start with an energy question to stay on the theme of this track. Oil companies made no secret of the fact that they